Good morning. Saturday, June 11. I'm back from a week at the beach. A lot happens when I go away. It's usually the way it works. Can't say anything really surprises me at all. Maybe the folks in CNBC, but they were literally spitting out their coffee yesterday morning when the CPI numbers came out. Clueless, depressed. But anyone who's been in these rooms should not have been surprised. I don't think anyone was surprised. We have a lot to talk about. It's been almost a week and a half since I did one of these spaces. Got a lot of talking points that I want to go over. See a lot of friendly faces in the room. Three Aces, good to see you. Tom Thornton, good to see you. Jeff Garbaz, good to see you. Dave Narkowski, God Almighty, we got murderers row here. This is awesome. Not sure where to begin. I may actually, though, start with a topic which I adopted as a title for the room. I don't want to go too hard on the guy, but people say it's bad form to criticize people, that you should praise specifically but criticize only generally. I disagree with that completely. And the reason is because there's so much nonsense that people are getting away with in the financial media and in FinTwit. And a lot of people are just getting hurt, innocent people. And you may say, well, people should take responsibility for their own investments, and they should, and they do. That being said, there's literally no accountability for these people who just talk garbage, throw stuff against the wall. And it's in the financial media. I know my good friend Tom Thornton, who's right up the top row, and Tommy's a must follow if you're not already following him, or you should subscribe to his service if you're not. He takes his craft very seriously and takes it personally when he gets something wrong. He'll fall on his sword. He didn't ask me to say this. We've not spoken in a week. But he's a pro. And Mr. Garbaz, Jeff Garbaz of Quantitative Partners, Phil Erlinger's firm, same thing. These are professionals who take great pride in their work. Unfortunately, much of FinTwit and the financial media does not hold itself to the same standards. And I think it's a travesty. And people are getting hurt. It's just outrageous. And so I think someone needs to sound the alarm and warn people. And just as if I made a horrendously bad call in hyperbolic fashion, like many of these folks do, I don't know if I could show my face in public. But somehow these poseurs, these charlatans, they just carry on. And I hate to say this, but Mr. Cramer deserves special mention. He's been one of the worst, one of the absolute worst in this regard. And people just forget about it. And he goes on to the next representation. Don't worry, we're going to get to the markets. But I just had to get this off my chest. And I'd like to play, let me see if I can find it here. I'd like to play for you. There's a great compilation of Cramer greatest hits or worst hits that I heard recently, this morning, as a matter of fact. And if I can find it, I'd like to play it for you. Just give me a minute here. While I'm looking for that and fumbling around, I know Tom Thornton, you had raised your hand and wanted to come up on stage to speak. So, Tommy, why don't I turn it over to you? Maybe we'll get into maybe it'd be a good way to kick off. You could just talk about what you see going on in the markets, what's on top of mind. Meanwhile, I can scramble around and try to find the track that I'm looking for. So good to see you, my friend Tommy. How you been?
Hey, George. I've been great. It's been
Tommy, Tommy, speak up a little bit, please. I don't know if you're far away from the microphone or what, but just speak up a little bit, please.
Okay. I'm in my car. Let me Let me go off Bluetooth. Let's try that.
Okay, can you hear me now?
Yeah, that's much better. Much better.
Okay,
Thank you.
cool. Well, thanks, George, as always, for the nice compliment. I truly appreciate that, and I appreciate our friendship. And I really enjoy all of your spaces. They're informative, they're truthful. And speaking of truth, I just want to say, so I'm friends with people that have made really big, bold calls in the market and in different types of markets. And the thing is, I am still friends with some of these people. I'm always going to be friends with people. Uh, they've made really bad calls. I have implored to many of them to jump on your sword, own it, move on, and you know, somewhat apologize for such a bad call. And I can go on different sides of it. It could be the bullish call in crypto. It could be the bearish call in on Tesla. It could be all these absolute fact type calls that these people make. Now, I will tell you this: I met with Jim Cramer. I had dinner with him years ago. I found him to be a very nice, entertaining guy, and he told me a lot of what he does is entertaining. He tries to inform people. I think he truly cares, but there is a new level of Jim's calls that I think are getting a little extreme. Now, I will applaud him for his consistency. He's been consistent in the sense that he is super wrong on a lot of big calls that he's made. I mean, we can go back to the Bear Stearns is fine. That whole thing was crazy. Making the absolute calls on there's no recession. It's really hard to do that. And a bunch of different times, different things that I like to immediately take responsibility for and and get past it. It's a cleansing thing. Okay, I was wrong. It's not like I'm betting my entire portfolio on one idea. I'm very diversified. I preach that. I've tried to explain to some people that have been, some different outlets that have become too one-sided on one type of asset to preach more or talk more about diversification. That doesn't mean 10 different bitcoins or cryptos. That's not diversification, but more of an asset allocation for your life. One thing I will say, as far as being wrong, Mike Novogratz uh, had a classy mea culpa. And he just said, "Look, I've got this tattoo," which, I mean, for the love of God, why did he do that? And he said it's a humbling reminder of how difficult markets can be and how they can bite you. And I think that that is a really important thing. I've never heard Jim Cramer apologize or admit that he got it really wrong. And I think in many respects, when people do that, they earn credibility. And I think that's the important thing. Going into a little on the markets, I've been saying all year we're going to have a series of bounces. They're going to be lower high bounces. They're exploitable. The last one, I think, was 10% in the S&P and 12% in the Nasdaq 100. I got long. I've been trimming like mad over this week, all the long positions. I'm still barely net long, but I've got a lot of cash. And markets move fast. You've got to be really quick to adjust. And I had some people say, "Well, why were you long at all going into the CPI?" And I said, "Well, because if the CPI came in at 8.2 versus 8.3, it probably would have ripped. You probably would have had a 3% upsize rip in the market. So I like to stay balanced. I'm wrong. And in this type of market, you can afford to be wrong uh, quickly and move on. And that's important. I can be wrong to sell things too quick or short things and cover them too quick. I hope that's my big mistakes. But I had to tell my people I cut some longs, small losses on earlier in the week, and I said I just don't like the look of what's going on in this range, and there's a gamma exposure under 4100 or above 4200. This market's going to just really move. So I tried to keep my exposure in line. Now, if anybody has seen or read what Stan Druckenmiller said, it's absolutely spot on. It is very hard in a bear market to be short. It is very hard to be short. It seems very easy in hindsight. You could say, oh, that was easy. But you can get caught out in squeezes. So you have to be nimble. You have to keep diversified, keep your position sizing moderate. And look, I think Stan is just waiting for an up move to lay out shorts. He may not get it because, look, we're right at the the May lows, and if we break that this week, which we could, I see a move, a measured move to about 3,400 to 3,500. It may not be in a week, or it may not be this quarter, but I think we're going to have. That's going to be the target on the downside. So I'll let everybody. I'm roasting in my car here. George, take it away.
Tommy, thanks for that. Love to hear your commentary. You and I, a lot of mutual respect. I don't always agree, but it's kind of funny. I got pissed at you when you went long for the bats. You were right, and I'm just like, you know what? I'm too stubborn. All right, I covered a few shorts. I still kept some on, but I'm trying to just stay in gear with trend. And you're more, and I know people marveled at my use of the word adroit when I described you as the adroit Thomas Thornton in a tweet this past week. You were more nimble and tried to catch the turn. You got it right, and you were very right. But then the problem you have is, okay, so you got right, and then it turns down and you're stuck long. Net, you probably made some money. For me, I'm just trying to get the big picture right, and I'm not as, and also for the individuals in the room, maybe don't trade as well as you do. I think there are many ways to make money, and you have to consider what are you comfortable with, what's your time frame. And I really like this example because you and I have the same big picture view. It's just a question of time frames. And what I'm reminded of listening to you speak is this is a hard business. This is a hard business, despite what Jim Cramer would have you believe. And I value your friendship and your intellect, Tom. It's wonderful to hear you. If you can stay with us and hopefully turn your air conditioning back on so you don't roast, we have a lot of ground to cover. I am going to get to the Stan Druckenmiller comments in a while. I do want to start off, though. This is going to be about 6 minutes. This is a compilation. And I'm not here to ridicule. I'm here to remind people this is a hard business, all right? And I think, Tommy, you hit the nail on the head. People who just go from one disaster to the next, no accountability, no humility. I mean, if you're working at a real firm with compliance measures, you're not allowed to do this sort of thing. You may even run afoul of laws. But in FinTwit, in on television, the financial media, people get away with murder. And I think all people of good conscience need to call this type of behavior out. It's just outrageous. And I don't know. I actually like Jim Cramer, but I just don't know what he thinks he's doing right now. So let me just play this for a few minutes. This is it's a 6 minute compilation. I'll tweet it out. A 6 minute compilation of some of his worst calls of all time. So Tommy, what's amazing? I tweeted something. The title of the room today says chart suggests a very nice summer for stocks. Okay, that was a freaking Jim Cramer declaration on May 31st. May 31st, 12 days ago. And then he turns around, is wringing his hands on TV yesterday. Oh, they got to raise rates more, blah, 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 blah. I mean, on what planet is this type of behavior acceptable? And the problem is, if you're not paying attention and you're not doing the work, yeah, it sounds convincing, but you got to realize this guy's just throwing stuff against the wall, and there's no accountability. There's no accountability. There's no apology. It's just outrageous, Tommy. Thoughts?
Hey, one thing.
Thomas? You're breaking up, Tommy.
Okay, let me go outside my car. One thing, George, I just wanted to mention two things, actually. We are doing another trader meetup for those people around the New York, Connecticut area at the Cisco Brewery, not in Nantucket, but in Stamford. They have another location, and we're doing it on Wednesday at 7 o'clock. I'll probably get there a little earlier, but if anybody wants to come up, it's free beer, which is, worth coming up. there should be some good traders. And George, I hope you'll come again. You did the
Tommy,
last one.
I wouldn't miss it. Maybe we'll do a space. Maybe we'll do a space that we did last time for the brewery. We'll see. I would look forward to it.
That'll be cool.
That'd be great.
One thing also. I don't watch CNBC that much. I mean, very rarely. I listen. I watch Bloomberg. I found a couple years ago, I just needed to turn it off. There's too much noise, and it was distracting. So if anybody wants to try a little experiment, turn it off. Watch Bloomberg. It's real business news, market news. Try that for a little. Take a month and do that. Don't watch CNBC. Turn off Jim Cramer. I mean, I see his tweets and all the people that comment on it, but that might be something that is an experiment, and just I think people will find it a little bit illuminating.
Yeah, so. Tommy, I couldn't agree with you more. I've been watching. I did exactly that about a year ago, and between Tom Kane, Lisa Abramovitz, and Jonathan Farrow, it is infinitely miles better than CNBC. No question. CNBC, my girlfriend said to me best. CNBC is like People Magazine. It's People Magazine of finance. That's what it is. So I couldn't agree with you more, Tommy. All right. With that being said, I want to play this. Yeah, so Tommy, I'm going to play this Jim Cramer thing for a few minutes. This will last 6 minutes or so. It's unbelievable. I know you've all heard this before, but to hear it all put together the way this guy did is just extraordinary. So let me just play this. Hang on 1 second, boys and girls. Here we go. Where are we? Here we go.
Is known for his bad calls, and here he is advising Mad Money viewers that Bear Stearns is fine in the spring of 2008. Just 6 days later, Bear Stearns would fall 90% and get bailed out at $2 per share.
Okay, Peter writes, should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No. Bear Stearns is fine. Do not take your money out. This is real. If there's one takeaway other than the plus 400 somewhere, Bear Stearns is not in trouble. I mean, if anything, they're more likely to be taken over. Don't move your money from Bear. That's just being silly. Don't be silly.
He's not saying literally, I'm asking you to buy Bear Stearns. For that, you'd have to go back a full 7 weeks before the stock completely collapsed.
I'm asking people who are watching this video to buy Bear Stearns.
Now, that was 7 weeks before it collapsed.
Here's a clip from 2010 where Elon Musk brings up his Cramer call and says he's a contraindicator and responds to Cramer saying the Tesla IPO is, quote, not a smart investment.
There are a lot of people who have looked at your IPO who have told me, you know what, I'm not sure that this is a smart investment. Our own Jim Cramer yesterday said, I'm not sure that Tesla has a business plan that's going to work. It's not a smart investment. What do you say to the skeptics who look at where Tesla is, the money that you're raising, and they say, you know what, they've got a nice roadster, but they don't have a good business plan?
Well, I think, Jim, I'd say, yeah, sure, Jim, we're no Bear Stearns, but I think we're going to do okay. Jim, I think, recommended Bear Stearns and Lehman and other things. So, frankly, he's a contraindicator.
On March 25th of this year, Jim Cramer said that the bear market is over, and since this call, the Nasdaq has dropped 17%, the S&P 11%, interest rates have been raised, and inflation is still at all-time highs.
Maybe, Jim, you make the case, and you can make the case that everything the professor said is known. It's all in the market.
That's it. That's
Jay
why
Powell, his message, he's told you.
That's why
he's told you what's coming.
Have you looked? There are 600 companies that came public in the last 18 months. I mean, there's like 7 on the trade north of $9. I mean, this is the bear market, just like 2001, except for we have rates much lower. And Brian, you remember those days? I mean, those companies were all jokes. A lot of the companies, I'm looking at all the companies that are under 10. Many of them are actually making money. We are in some weird market that it's a bear market and no one called it as a bear. And I think the bear market is over.
Wow, and that's a big call. Brian Belsky, react to that.
Well, I think the bear market has been over for a while when you have over 70% of the stocks in the S&P 500 down more than 10%. You have 50% down more than 50%. 10%. But I think the key thing that is difference between 2001 is, remember, we were by the dip craze big time, and we were still so focused on one area, that being technology. I think the market's actually done a really good job diversifying itself. But remember, too, the interest rate scenario goes up because the economy is improving. And that should be very, very good. Remember, stocks lead earning, which leads the economy. And so it's already in the market. We already know this stuff. And this incessant need for everybody to know everything all the time, Scott. The Fed did a wonderful job last week kind of mapping this out. So we know the chart path. Now let's invest accordingly. And that's why the market's going up.
Here's Cramer saying that you can get 35 to 40% on Ethereum when it was almost at 3K. Since then, Ethereum has gone on to drop 30%.
This is like, we're talking money, so it's okay to say, hey, listen, made money. But I think Ethereum is terrific. I'm a believer, and I think that you could easily get 35, 40%.
Moving on to the next call, last year, Jim Cramer displayed his magnificent 7 stocks, and to date, 6 have been killed, with the only one left being Tesla.
There are thousands of stocks where earnings still matter and matter a lot. But then there are a handful of high-profile growth names where they just don't seem to mean a thing. I have a list of the most impervious ones. Tonight, I'm going to reveal them. I'm calling them the Magnificent 7. These are 7 companies where buyers don't seem to care how well the underlying companies are doing. They just want to own the stocks regardless. The Magnificent 7 have detached themselves from all metrics except the metric of wonder. In each case, the thesis is so powerful that it overwhelms any mundane attempt to figure out what the business might be worth. What matters is that every day seems like a buying opportunity, whether the stock is up or down. The first member of the Magnificent 7? Netflix. The earnings themselves are simply an abstraction for these thesis stocks, and any disappointment is simply one more reason to buy them.
Netflix is down 61%, Roku 70%, Peloton 83%, Square 60%, PayPal 68%, and Zoom 65%. And finally, Tesla, the past year, is up 25%. Continuing with stock calls, in February of this year, Cramer tweeted, winning stocks I like, Upstart and Airbnb. Since then, Upstart's down about 80%, Airbnb 40%. In April of last year, when Coinbase just went public, Cramer endorsed the company, saying it's a $475 stock. Since going public, Coinbase is down over 80%.
Now, I'd love it if you can get Coinbase in the low 300s, around 10 times sales. That seems unlikely. If you're willing to pay 15 times sales, not unreasonable, then this is a $475 stock. That's the upper end of what I'd be willing to pay for a large position. Still, you've got my blessing to put on a decent position at the opening, maybe half of what you'd normally purchase in one go, and then buy more, but only if it comes in. The bottom line, if you like me, well, then you're a big believer in cryptocurrency, and you will want to own Coinbase for the long haul.
Coinbase isn't the only going public company Cramer has endorsed at all-time highs, only like clockwork to immediately drop mere hours after making his call. So Lyft went public in March of 2019, and since then, it's dropped to under $20 a share, down 75% from its all-time high in Cramer's call. So finally, we already mentioned Netflix, which Cramer endorsed last year, but he also tweeted in January of this year, Netflix, buy, only for the stock to tank 70%. So, just look at that tweet. Cramer says, buy Netflix, and boom, 6 red candles, 6 days in a row. And that is actually hard to do. Like, even if you tried, you couldn't make worse calls than this. So many of the comments in response to these Cramer calls were simply about, how the hell is this guy still on TV? Just his call from 2008 should have been enough. But nope, here we are, and Cramer is still at it. All right, so I'm going to leave it at that. There's a bunch more I could have thrown in, but I think you guys get the idea. Don't trust Cramer, and please subscribe. Thank you guys for watching.
Wow. What do you do with that? And again, this is a hard business. If you're any good in this business, you're wrong 40% of the time. That's not the point. People can make fun of all my mistakes. That's not the point. I've made more mistakes than anybody else, probably because I'm older than anybody else. It's just, how do you go from one disaster to another in hyperbolic, sensationalist fashion with no remorse, no humility, no apology? It's just staggering. I will put the link to that video. I'll tweet that out in a while. But I just, all kidding aside, this needs to stop. It really does. There's a lack of regulation here. As is always the case, the regulators don't keep up with technology. I'm thinking of Twitter now. Jim Cramer's not the only one. Many in the crypto world. Raoul Pal deserves particular mention. There's a guy who also used to work at Goldman Sachs. what he's doing is maybe not illegal because he's in the Cayman Islands, but it's certainly unethical. And again, no apology, no remorse, no humility. Mike Novogratz, Chamath, Kathy Wood. I mean, seriously? Could you imagine any fiduciary, any investment advisor who has any conscience proclaiming that their stocks will go up 50 or 60% annually for 5 years? I mean, enough. I'm making a serious point. This is not a ha ha ha, let's dump on these people. What are we doing here? Where are the regulators? Where's Gary Gensler? I think most of us were brought up to do the right thing, not to do what you can get away with. But if you're after eyeballs and clicks and it sells, go for it. That's what these people are doing. Jim Cramer, I ask you to stop. Raoul Pal, I ask you to stop. Kathy Woods, stop. You know what? In the end, it's not really going to matter what I think or any of us think. Mr. Market's going to fix this. Mr. Market is in the process of fixing this. We'll get onto that in a little while. Many things I can talk about here. Motorhead, please hold on for a second.
Okay.
I'd like to. We'll get to Tesla in a bit. I'd like to go to Mark Newman though, because Mark, if you're listening, you and I have talked about this sort of behavior for a while. I know you have opinions, Mark. If you're there, could you unmute yourself if you want to weigh in, Mark?
Hey, George. Hey, everybody. I just wanted to reflect a little bit on what Tommy said, and he just hit on a lot of great points, which I think everyone in the market needs to always have an idea on their time horizon. And Tommy is one of the best at calling market turns I've seen in a long time. And one of my buddies on the West Coast said, "Do I know Tommy?" And I said, "Yeah, he's very good at turns, market turns." And my buddy subscribed and said, "He helps me when there's an inflection point and I need to decide to sort of cover a hedge or maybe add to a long." And then Tommy mentioned Stan Druckenmiller, legend, obviously more money than everybody. And he has always been a long-term investor thematically when he's done his best, right? And he's short-term, he can always be made to look sort of silly. Recall like getting carried out in the NDX in the spring of 00. Stan, has a legendary story of just flipping around and getting all caught up. And I think everyone who uses or leans on or, listens to guys like Tommy, guys like Stan, etc., you always have to have that context of what am I playing for? And like even Tommy highlighted Stan saying that it's hard to make money short. Yes, I think it is if you're trying to trade around it, right? Because I think in this environment, it almost feels like shorts are investments and the longs are trades. And I think that you have to define your context, your horizon in all these trade situations. Tommy nailed the bottom a few times on these bounces, right? And George, you were saying how he was like, frustrating guys who are like leaning short, whatever, by being so right. And I also think that Tommy sounds like he is a very good short-term trader. And if you're trading with Tommy and you're not trading sort of the stylistic way Tommy does, which it seems is short-term and seemingly very successful, by the way, if you go into Tommy's trades or you lean with Tommy or trade with Tommy, you can't have a sort of varying time horizon because you have to have a defined time horizon or you can get caught, right? And I think that's very important in this environment.
Yeah, Mark, 100%. You and I are both vying for president or chairman of the Tom Thornton fan club. 100%. I just want to say what you said another way, which is, we're just going to repeat what you said for emphasis. And you know this. There are some guys even leave Tommy out of it. You got to pick your time horizon, whether you're short term, medium term, long term, and you got to focus on it. You can't drift from one to the next. So if you get caught in between, sort of like in tennis, you either can stay on the baseline or you can rush to the net. If you're in the middle, you get screwed up. I think that's what you're saying, and I couldn't agree with you more. And Tommy's great at rushing the net and getting the short-term wiggles. I'm not as good as he is, and so I continue to want to stay on the baseline and use my ground game. But so sorry to interrupt you, Mark. I just wanted to elaborate on that point. But Mark, could you speak a little bit to the lack of integrity and lack of accountability in FinTwit and in financial media and on the street?
Yeah, that's another thing. I'm amazed at the number of uh number of folks out there who George, you highlighted to me, I think you were one of the ones who said it first. You tell the truth, you're trying to help people. If you tell people what they want to hear, you're helping yourself. And I think that when you see folks doubling down and saying to everyone, keep buying the dips and those kinds of things, you're sort of pushing the narrative that you think will get you more following, more coverage. You don't really care about being right. You just care that people are following you and what you've said sounds really cool. But in the end, you know, the idea is to educate people so they don't make the same mistakes, repeat making mistakes. And, you know, the in the empire of lies, truth is the enemy, right? And we continue to talk about things that are real, things that are actual. And I think there's a lot of theory and wish and want in the FinTwit universe. And I think that, you see guys with tons and tons of followers saying, oh, Bitcoin's going to 1 million. Well, okay, I think that's what your followers want to hear. I don't think that's really scientifically tested. And there's a lot of that out there. And we are in an era, an age, I think, of, bigger and bigger frauds. And I think it's internet enabled, it's related to technology, and it's related to the Fed. And I think we're seeing that now. You need to be very careful. If people are saying things that you are like, that's completely crazy, you're probably right. It probably is pretty crazy. The more preposterous it sounds, the likelihood that it probably is.
Well, extremely well said, Mark. Tommy, do you want to respond to that? Tommy? Please unmute yourself, Thomas.
Well, okay, can you hear me now?
Yep.
Hold on. Okay.
Yeah, we hear
thanks,
you.
Mark.
We got
That's
you.
very nice. Okay. Thanks. That was very nice of you to say. Look, I sometimes I'm not necessarily a short-term trader. I'm not a day trader. I'd like to have some positions work a little longer, quite frankly. Some of the long positions that I recently put on, and it was across different sectors. I would have liked to seen them play out a little bit more, but I got enough out of them. I squeezed the lemon in this bear market for all the juice on that bounce. So that's great. It is harder. And just one thing about being like short in a bear market. Our firm, our hedge fund, was notoriously known for being net short in its existence for 11 years. And we lost money one year. We lost money in 2008 because we were down 1%. And I was pissed about that. But regardless, it's really hard when you're long something and it's working and it's going up. I have a story of the guy that I know that he got into Bitcoin in like 2013, $30,000. He cashed out in late 2017 at that peak. And he said he was so stressed out watching it go up. And he was so right. And he was making so much money that it like he was panicked. And it's the same way sometimes in a bear market, you are max short and short $1 billion of financials. We had much more than Front Point. They got the notoriety. But I'll tell you, it was really hard.
Tommy, you're breaking up.
Position
Tommy,
I have, the gains that I have are going to be gone. Oh, sorry.
Yeah. Right.
Okay.
Yeah.
Sorry.
Tommy, why don't you come back when you got a better connection? Let's move on.
Okay.
You got a lot of great people in this room here. It's unbelievable. So Tommy, just mute it, please, because your mic is not really working properly. So I want to get to Motorhead, and then we've got this is shaping up to be just an extraordinary room between Newman and Thornton, and we got Michael Green in the room, John Roque, Michael Belkin, Three Aces. I'm just going Jeff Garbaz. I'm just going down the list. Dave Nikoski. This is one for the ages. All right, so we got a lot of wood to chop. So let's turn now to reference was made earlier to Stan Druckenmiller and comments that he had. I believe he appeared at the Ira Sohn conference this past week. Stan is the GOAT, greatest of all time. If there was a Mount Rushmore for hedge fund managers, he'd be on it. I think he's never had a down year in his 30-odd year career or thereabouts. And so when Stan speaks, I listen. And I'll tweet this out later, but I just want to briefly paraphrase from some of his comments from the transcript of his remarks earlier this week. Well, this will take about a minute, so let me just ramble here. I'll paraphrase. On the bear market, my best guess is that we are 6 months into a bear market. For those tactically trading, it's possible the first leg of that has ended, but I think it's highly, highly probable that the bear market has a ways to run. 2, on a soft or hard landing. If you're predicting a soft landing, it's going against decades of history. 3, on doing nothing. Currently, I'm going in every day and looking at my screen, but I'm pretty much taking a break. I've lived through enough bear markets, and that if you get aggressive on the short side, you can get your head ripped off in rallies. 4, on the past few years of a bull run. That period was incredibly costly because a lot of assets were purchased during that period that a lot of people moving out the risk curve will lose a lot of money on. Next, on owning bonds. While I'm not comfortable owning bonds, I'm much less comfortable being short fixed income to the degree that I was 6 years ago. On a recession. Given the extent of the asset bubble and destruction in the markets, given what's going on in the Ukraine, given zero COVID policy in China, I don't take a lot of comfort from that. So I assume, and pretty strongly, that soon we're going to have a recession sometime in 2023. 7, advice for new investors. If you're not really passionate, if you don't love this stuff, go do something else. I have guys who have IQs 50, 60 points higher than me who stink in this business. Learn all the asset categories and how they integrate. And so that's pretty much it. So again, this business is not easy. It's particularly not easy now. Those words are from one of the all-time greats, Stan Druckenmiller. So I think we need to take heed of that. It was only a week or two ago when everyone was convinced that bond yields had topped, that the bottom was in. We're going to have a nice summer rally. We were picking on Cramer earlier about how the summer's looking to be a very nice time for equities, blah, blah, blah. But it's the nature of bear market rallies that, they're unpredictable and they're very hard to trade. And, again, the great John Roque, I don't know if John's still in the room, but we've mentioned this many times in this room. John compiled a table of the epic 2002 bear market, where NASDAQ declined by 80%. By the way, I'm smiling right now because I just noticed here Bitcoin is down 2.5% as we speak to 28.4. What could possibly go wrong? Anyway, in 2.5 years, NASDAQ fell 80% in the 2002 bear market. I believe 46% of those trading days, the market was actually up, and there were 15 counter trend rallies of 10% or more, 10 counter trend rallies of 15% or more. So I think you have to figure out what you're good at or what you're comfortable with. Mark Newman was making the point earlier. I'm more of an investor than a trader. I'll peel some shorts back when it gets really trashed, but my core position doesn't change. In a bear market, you only can be short or flat, short or flat. In a bull market, you only can be long or flat, long or flat. You got to stay with trend. And trying to trade counter trend rallies is extremely difficult. If you're as adroit as Mr. Thornton, maybe you can do it. That's beyond my pay grade. So, I just kind of grin and I try to peel a little bit back when things go too much in my favor and zig and zag. But I think we are a long, long way from the end of this bear market. The bear market's only just gotten started, in my opinion. This is not the beginning of the end. This is the end of the beginning. And for those of you who were in the room a couple of weeks ago, when James Ferguson gave a real tour de force as to why inflation is a problem and not going away anytime soon. If you haven't heard that interview, you should go back and listen to it. I think Jerome Powell and the Fed would learn a lot from it. They're just completely wrong, have zero credibility, and the whole street. I'm not going to mention names, but virtually every frickin' Wall Street economist was talking, inflation's peaked, inflation's peaked. I'll read you some other stuff later. If you look at alternative calculations of inflation, if you look at the way inflation was calculated back in the 70s or 80s, it's in the double digits. You can splice and dice and wordsmith all you want, but no. I like Jim Bianco's definition of inflation the best, or when we talk about transitory being if you don't do anything, will inflation go down sufficiently on its own accord? And by that definition, it ain't transitory. I don't want to get into the argument. Well, it's 8.2, it's 8.6. Oh, look at the replay. Oh, his foot was on the end line. Bullshit. All the inflation apologists have been completely wrong. Completely wrong. And they have no intellectual standing to make the case that inflation is not a problem. I find it extremely interesting. This is another point I want to come on to. That real bond yields actually went up this week. And that's quite interesting. There's a fantastic web podcast I urge everyone to listen to. I tweeted it out a few days ago from Louis Gav of GavCal. There was a lot of stuff in there that we all heard before. What particularly caught my attention was his idea of the deglobalization, not of trade flows, we know that already, but of capital flows. And speaking about how, all these surpluses have been amassed by other countries, recycling them into assets in Europe and the U.S., particularly, be it U.S. Treasuries, real estate, equities, et cetera, and that in the brave new world we live in, post-Ukraine invasion and the sanctions, that maybe it's just not going to play that way anymore. And if that's the case, that's profound implications for real interest rates in the United States. So I maintain my bearish view on rates. I've been completely right. Everyone who's been saying the opposite has been completely wrong. And if I sound like I'm testy, yeah, I am, because I'm sick of hearing the bullshit from people. John Roque, who's been completely right, was calling for months for a 3% target. He's now calling for 4%. And that wouldn't surprise me. You have all these people out there who have this sort of simple framework, assumes correlations don't shift. Well, if growth goes down, that means inflation has to go down, it means you should buy bonds, leaving out all the other things that are going on in the world, such as the changing geopolitical dimensions. They're completely missing it. This is, as Andrew Smithers, who's still alive, former strategist for S.G. Warburg, now on his own. This is the worst case of stockbroker economics, completely bereft of any analytical rigor, and it's just brainless, superficial brainlessness. And that's why the street's completely wrong on this. So, it's interesting. The market's crashing, yet we've got the 10-year up to 315. It's about to make a new cycle high. Oil's barely budged. Crude went out. WTI went out at 120. A dollar is cycling back up again through 104. So we've got the triple demerit scenario of rising interest rates, a rising dollar, and rising oil prices. At a time when the flows have still been strong into equities, but at some point, I believe these guys are going to blink. I mean, the market's been this bad despite positive inflows. Just imagine for a second if the retail crowd loses some of its conviction. And, at a certain point, the pain will be big enough where they're going to say, get me out. When it's going to happen, I don't exactly know. So let's move on to some other speakers. Audrey, and then Bick. Audrey, please unmute yourself. Okay.
Sorry, had to unlock my phone. I don't know if you want me to speak right now. I was going to backpedal back to Cramer a little bit.
Yeah. You can talk about anything you want, just no Tesla. That's all. Just ground rules for everybody in this room. No more Tesla talk. Okay.
Okay.
Go ahead.
I might say the Tesla word once, but I'm not going to talk about it. So I just wanted to talk about Cramer mainly, and the fact that there's no accountability where he's concerned. My personal narrative is that my dad, committed suicide during the dot-com crash. And before he did that, 24/7 he had Cramer on. And, a lot of mentally ill people, turn to drugs, turn to alcohol. Guess who my dad turned to? Cramer. So to this day, I cannot be in a room with Cramer on. He leaves such a bad taste. His voice, it just leaves such a bad taste in my mouth. So that was the first thing I wanted to say. But the bigger thing I wanted to talk about is why we kind of discussed this, I think, in Peter Atwell's room, but why are people gravitating to idols? We talked about the NFTs, the crypto, the Tesla, the ARK. I mean, I realize we're in an everything bubble, but I go in rooms all the time. I'm in a crypto room. I'm in a Tesla room. I'm in a gold and silver room. I'm in an energy room. I hear the same thing. They're bullish. We're going to make it. Everything's going to be great. Now, granted, energy has made it. It's been doing great and everything. But I'm just it's all the same. is it because like our, you know, a country is supposed to have like a strong culture? Is it because we don't have a strong culture? Is it like, I just don't understand why, number one, why there's no accountability and why we're having these factions where people are looking for salvation in any way possible to find some sort of hope. I guess that's the question. Like, what's going to happen? Obviously, they're going to get hurt, but like, why are we breaking up into these groups? So
I think it's a strength in numbers thing. Like they believe that there's strength in numbers, and if I believe, like, they found someone to confirm their bias, and so then you're looking at a small faction of people. Like, I mean, George has 900 people in this room, right? So you look at it and you go, there's 900 people who feel the same way, right? We're going to win. So it's this strength in numbers, but
yeah, like
it doesn't work. Yeah,
a hobby room.
Yeah, that doesn't
With,
actually work. And
with
I also think it's it's almost like, I call it lazy trading, right? Because they will spend hours in these spaces listening to someone else tell them give them confirmation bias, but they don't go and educate themselves on how all of this really works.
Yeah,
and
it's just really scary because every room's the same exact thing. We're all going to make it. Right. We're all bullish. It'll be okay. And it's almost like the foreboding of like what George keeps saying, things are going to get so much worse and no one's listening. No one sees it.
Correct.
It's really sad.
Yeah, 100%. And it is sad to see. And God forbid you try to help anyone with that, because then you're against their narrative and you're this, you're that, you're a shill, you're turning against an entire community of people. How dare you? With that kind of thing. So you can't even help if you want to. So yeah, it's sad, but sometimes, like, I'm to the point where they're gonna have to look. This is maybe harsh, but part of a healthy market is that people get blown out, right? People have to go bankrupt. Like, that's just what it is. That's part of a well-functioning market, and not this irrational market that we live in where everybody wins and it's bulls all the time. That's not a healthy market. So it's sad to see, and you can look at people and go, you're going to get blown out, you're going to go bankrupt, you're putting your whole 401k, and I feel really bad for you. But if you're not willing to get any help or educate yourself, then you're just going to have to be the sacrificial lamb.
Right.
That's kind of how I look at it.
Yeah. So Amy, that's great. Let me just pile in on that. Part of this, I mean, this is the direct consequence of the most irresponsibly reckless monetary policy in history. And the trend is your friend, and it's recency bias. People keep doing more of what's working, and they keep doing it, and they keep doing it, and then you get a regime change, and now the boat's flipped, and they're caught the wrong way. So it's sort of a mutual admiration society where it's like, I'm good, you're good, we're all good, right? This is sort of like a generalization of the AMC, the pathetic AMC rooms. And we should get my good friend Mark Cahotes up here to talk a little bit, because he and I may had the misfortune of going into these rooms and trying to convince some of these people that maybe, just maybe, there was something wrong with their investment thesis. But they're trapped, they're the wrong way, and they just can't. There's something very cathartic about taking a loss. It's not the loss that kills you, it's the mental capital that you waste by just staring at the position and being in denial. Once you take the loss, it's out of sight, out of mind. You can start over. These people are all stuck, and they're caught on the wrong side of things, and they have charlatans like Cathie Wood and Jim Cramer leading them on. Again, there's been complete regulatory failure. There are no adults in the room, and you have a whole generation of investors who are going to get completely destroyed. And this is not without precedent. I can remember starting my career at Fidelity in the 80s, hearing stories of what happened to people in the great Nifty 50 bull market. And it took a decade or two for them to come back, and then we blew them up again in 2000, and now we're blowing them up again. And this is tragic. But this everything bubble, this is far bigger than anything we've seen before, and it's going to have far more disastrous and long-reaching implications, in my opinion, than anything we've seen before. This is going to be a complete and utter wipeout. The fact that Cathie Wood is still taking in money despite being down, I believe, almost 60% this year and 75% from the top. Need I say more? This market will not bottom until that type of behavior has reversed itself. And so I think, I mean, Audrey, I feel for you. I'm, it's horrible to hear what happened to your father, but I'm really glad that you told that story, because this is not a game. This is not a game.
No, thank you. Yeah, it's not. And
I wanted to say that too. I'm sorry, Audrey.
Oh no, it's okay. I can't hold Cramer for responsible for my dad's actions. But what I can just say is I can't listen to his voice. Every time I hear his voice, there's that association. And if he burned my family, I mean, if because of this, my family got burnt, think about how many other families are going to get burnt from, Kathy Wood, from Cramer, from all those charlatans, like you said. I mean, it's just going to get, exponentially worse.
And Audrey, there is no shame. There's no sense of decency. There's no accountability. I mean, seriously. I mean, it's enough to make any person of good conscience have their blood boil. It's outrageous.
Hey, George, have you seen? I know how you like to also talk about Tiger. Have you seen? Take a look at the chart in the Nest. The VC valuations are down, crypto level carnage, 60% plus. There's a chart in the Nest there for you.
Yeah,
Audrey, if it helps, I pretty much fade everything Jim Cramer calls. So
yeah, I use them as a reverse indicator too.
Yeah.
I do, but I don't only. Like I said, I don't like to listen to them. When I see, something someone tweeted, I go, oh, okay.
Yeah, and by the way, Three Aces, we'll get to the Tiger in a minute, but Three Aces, if you could please throw up with an S, go look at Inverse Cramer. If you could throw something up in there. So Audrey, I don't know if you've seen it,
great.
but there's a Twitter handle, Inverse Cramer, and it was started as a joke, but it's actually serious. They keep track, they keep score of everything that Cramer recommends, and they advise to do the opposite, and that has been freaking money, absolute money. So again, it's Inverse Cramer, a definite follow for anyone paying attention. So again, Audrey, I'm sorry to hear your story, but thank you for that. And you actually, we can't change, obviously we can't take back what happened to your father, but I just hope people hear your message, because, unfortunately Cramer's listened to by millions and millions of people. And, this is, I'll play it later. I'm sure I'll play it later, but the clip where he was a few years ago, worshiping Elizabeth Holmes as the next Steve Jobs. Like, are you serious? I mean, I'm told, I don't know if it's true or not, that he's a little bit on the spectrum. I don't know. But he worships. He's such a narcissist. He just worships the adulation that he gets. And it's just horrible. Audrey, again, thank you so much for speaking up. I really appreciate it.
Thank you, George. Appreciate it.
Hey, George, the thing for me about all of these people, they all share the same thing in common, including the Maxis and the rest of them on Twitter and the various groups out there. There's absolutely no regard for risk. And I'm just curious, George, in your 40 years history and, all the reading you've done and everything else, have you ever seen a group of Maxis, things only go up crowd in the history of the markets, make it out alive?
No,
I've never seen a group of them make
this
it out
reminds
alive.
me the most of it's actually Japan 1989. I actually think that's the roadmap. Nikkei peaked at 39,000, went to 7. Today we're 25, wherever we are, and this is 33 years later. We have seen valuations that I will suggest we will never, ever, ever see again in our lifetimes, ever. This is preposterous. The EBITDA, the non-GAAP earnings, the this, the that, it's all bullshit. This is all driven by the most irresponsible monetary policy in history.
Well, it's also coming from the top, right? I mean, look at Adam Aaron. Adam Aaron is loving that he's some sort of D-rate celebrity. He's leading the retail investors on by telling them they own 90% of the float.
100%.
All of these things. So it's coming from the CEO.
100%. And but Amy, what I would say is, let's not get caught in the weeds here. Whether it's him or it's that jackass Kevin O'Leary or whatever, it's all the same thing. It's all the same thing. There's just a tsunami of liquidity came in, and these guys jumped on it and surfed with it, and they went with it, and it was their way of cheating, getting ahead, being relevant, making a lot of money. They're complete con men, all of them. All of them.
Well, here's the outcome of the trillions and trillions of dollars in free stimulus. This is what you get. That's where, like, I hope that the $3,000 checks were worth it, because this is what we get. It was going to come from somewhere. Nothing's free.
100%, 100%, Amy. Hey, Danny, good to see you. What's up, man, Danny?
George, how you doing, man? Caught me. I thought I was going to take the day off from the market on a Saturday, but you got me roped in with this conversation.
Danny, you can't leave. Come on, man.
I just have one comment, I think, and dovetail with your comment about where we're headed. We never dealt with the aftermath of the global financial crisis because of all the federal government intervention, right? Fed, Treasury programs, everything we saw. So part of this unwind that I think people are missing is that we have to now pay the piper, so to speak, for some of that. And so, yes, are the banks safer than they were? Absolutely. They're very, very well capitalized. But all the other things, the cushioning of the blow, price discovery, there's been no price discovery in bonds or equities now for 13 years. And so that's a lost art. And that's why it's going to feel harsh. And that's why it is going to be harsh. So I just wanted to tell people out there, having lived through that crisis and then, watching all the PPIP, the TALF, the TARP, QE1, QE2, QE3, all these things that happen, we now have to unwind that. And it's pretty simple. You don't have to go much farther than just that thought process and that type of liquidity, $9 trillion. I mean, that's it. So I just wanted to mention that and kind of tie those two things together, because for people that have been through all these iterations in various phases of the market, to me, this is now we're going to have to face what we didn't really have to face the first time around. So I just wanted to add that.
Danny, thank you for that. 100%. First time you and I actually speak, but I've heard a lot about you, and we've got mutual friends, and couldn't agree with you more. I mean, it's just, and the funny thing, I'll pile on with you, and that is, everyone says, don't fight the Fed, don't fight the Fed. That's what they said on the way up. Well, in point of fact, to your point, don't fight the Fed. They want the market to go down. They want to tighten financial conditions, okay? Then if you start on top of wondering about the whole, income inequality, social agenda thing, it's a whole other story, right? They want the market to go down. But all the apologists, the Cramers of the world and all the rest, all of a sudden they forgot, don't fight the Fed. And so, no, this is going to be, and again, I think people are going to just be shocked by not just the depth of this decline, but by the duration of it. There's no coming back from this. None. Zero. And now we're going to go to Michael K., who is going to speak to, Michael, please unmute yourself, why this is maybe the end of the beginning, nothing more, that whereas heretofore we've had, we saw the multiple compression part of the decline. Now the economic downturn is starting, and now the earnings decline is just getting started. So, Michael K., happy Saturday. What's going on, my friend?
Hey, George. Happy Saturday, everyone. I know a lot of people in this room are very focused on the near term and day to day, and a lot of the minutia. And I don't mean that in a way to downplay it. People focus on different things. I'm kind of more sitting back from the macro perspective, not trying to make calls the short term. I think we're in a bear market. I don't think it's over until the economy bottoms. And when I sit back and hear everyone talk about how all these things are different this time, I just keep going back to the simple idea that the economy is slowing for the same reason it has always slowed, going back 100 years. Rates go up, the cost of goods go up, the cost of money goes up, and the economy slows with a lag. And we're seeing it play out, in the way it always does, where housing gets hit first, along with multiples, and then it hits earnings. So I don't have anything new to add, George, but you and I have been having the same discussion for months, and the only thing that's changed is time has moved on, and so has the cycle. So I try not to get caught up in the near term stuff. Obviously, there's great opportunities here for traders. That's not really my wheelhouse. I just think you want to remain risk off until we're within the vicinity of an economic bottom, and that's not for at least another year. I don't think people appreciate how far out that is. Even Druckenmiller obviously makes a lot of big comments, and maybe we are certainly 6 months into a bear market rally. Does it mean we're only halfway through? I don't know. I would say no.
100% agree, Michael. And I find it hilarious still, pathetic and hilarious. There's some people still talk on television or in FinTwit that, we're toying with the bear market. We're toying with the bear market. Because the soundbite S&P is not down 20%, we're toying with the bear market. I mean, it's just like, what planet are these people on? It's just mind-boggling.
Well, don't discount the amount of people who have never traded a bear market. They
100%,
have to cater to them.
100%. 100%.
I think, George, one of the big mistakes people are making is they're looking at the market and thinking the only reason the market goes down is because when the economy goes down or earnings go down, and that hasn't been the case. Most of the sell-offs in the last 20 years, probably going back even farther, or most of the sell-offs in history are a function of slower growth, not higher rates and higher inflation. And so I think people are not conditioned, or they are conditioned to think stocks down, economy down. So we're pricing that slowdown. And I can't think of a time where we've had such a sell-off that's not been due to earnings in a very long time.
Yeah, because we've been in this 40-year great moderation post-Volcker era, and rates have only gone down and to the right, and therefore valuations on a secular basis only down up and to the right, and so that game is over.
Hey, Cantro, how is this consumer sentiment read 50-year low? Is that material, and where would you put that in your deck of cards?
Yeah, so I learned a good lesson. It's good to be wrong, because you hopefully learn from it. And I remember back in, I think it was in late 2007, probably. I'd have to go back in the data and look. And I remember, I was still a youngin', and seeing consumer sentiment fall to really low levels. Maybe it was in early 2008 and late 2007. And I did a study that probably everyone on Wall Street still does. We get to a weak data point and you say, well, in the next 12 months, how are markets doing when you hit such a, bearish level of sentiment? And, if you do that analysis on anything, it's always positive because stocks historically generally go up. And so I learned the ugly lesson, and it was dead wrong, that, in a downturn, in a bear market, sentiment isn't your friend as a contrarian indicator. At least, certainly not from an intermediate term perspective. Maybe the short term, again, that's not my focus. But, all-time low in consumer sentiment, it damn well should be there. Can you think of a worse time for the consumer?
Yeah, and Cantor, I'll just pile on that one. I think earnings are going to be absolutely horrific. I mean, you've seen it with some of the retailers already, and then just this past week, Target having to revise down again. I mean, there was a nuclear bomb went off a few weeks ago, and they revised down again this past week, saying they're only going to make $2 billion instead of $5 billion, whatever the number was, or 2% instead of 5%. I can't even remember. I was on vacation. I think earnings are about to completely implode, and you put them. You've always pointed out, you don't know what the PE is because you can't be sure what the E is going to be. But if I tell you the E is going to be much lower than you think, and then as you've been pointing out, rising bond yields, increasing credit spreads, $50 in double jeopardy, that spells lower PEs. Put that in the blender and see what you come up with. It's easy to see. In fact, I'd be shocked if the market doesn't go, the S&P doesn't go at least 3,000 from here. And if that happens, you can plug in whatever number you want for Cathie Woods or the Qs or whatever, or most of the rubbish that most retail investors own. Going to get absolutely destroyed. I don't know, Cantor, you want to push back on that?
No, I mean, you're singing the song we've been singing together. Again, everyone wants to know how bad it's going to be, or how bad can the data get, how bad can earnings get, and the reality is, anyone who's being honest, you don't know. We can't model shocks to the system, and a recession is a shock. And so we know it's down, we know it's worse, we have an idea of how long it's going to get worse for, but how much can the market go down here? It's a near impossible question to answer, but certainly the symmetry of risk is not even, and it's skewed to the downside. We know that with pretty good confidence. So, in the next week, I have no idea what stocks are going to do, but, strong conviction that over the next 12 months, there's very limited upside and very big downside.
Hey, George,
100%.
let me add one thing, because Danny Moses was on just before, legendary. Really good to hear his voice. Talking about having what we built up on from 2009, right? The expansion, 9 trillion, et cetera. The order of magnitude of some of these stocks is, in terms of the bubble, Back in '00, Cisco was the biggest at 550 million. Let's talk about the fall of 21 and how many stocks were above $1 trillion. Was it 5, 4 or 5 at least? So the order of magnitude that we've built up, having not cleaned out anything in prior crises, and we just layered on a lot of paper, the order of magnitude now is, I'm saying, 4x what it was back then. That's just a guesstimate, ballpark, but how far it can go on the unwind, we have an order of magnitude to clean out that no one's seen before, for sure.
And dude, it's a good thing. It's a good thing that the public's not buying this market on the way down. Otherwise, I might get really worried, huh? It's just unfreaking believable. All right, so hold on. So time out here. I want to do Tommy with a quick follow up, and then Michael Green, and then Jeff Carbaz. Tommy, you got a follow up?
Yeah. Hey guys. Michael, you had a really good point that we've seen this market. Many of the stocks in the market go down, and it's not because of earnings. So this, every market decline and increase, for that matter, has a little different taste and a little different mix to it. And so that is, in my opinion, something that is really remarkable. Now, Intel, guided lower on their earnings call, and then they were at a conference this week, and their IR or CFO was really, really bearish, and that will bleed into other tech names. It's a cockroach theory that's going to start happening. And George, you're absolutely right. The next big part is the earnings decimation, and it's going to be the big names too, because you can't just have the minions fall up buy from the big boys, and it'll all cascade. So I think that's the next part of this bear market, and it's been really important to watch and listen to some of the conferences, if you can get online and listen to what some of the CFOs and CEOs are talking about, because they're really giving good clues on what is happening with their businesses. And so it's a little different every time, every market. And we're coming into July earnings, and I think you're going to start hearing more earnings guide downs, and I think you're gonna have Apple and some others. I mean, Microsoft guided down on FX. I mean, for the love of God, what forex are they trading? Because the dollar hasn't been that wacky, so it's a mystery to me. But you're going to see more guide downs, and that's what the landmines for being long in this market. And the last thing I'll say, retail they have inflows all year. And I said the other day on one of my notes, the retail has not capitulated. And that is the most important thing, because there's so much inflows from 2021. I mean, there was $1 trillion of inflows. We haven't seen that money come out of the market. It's been evaporated in many respects, but it's not out of the market. We don't see that happening yet. So that's the next several phases of the decline. So that's it.
Thanks,
George.
Tommy.
Wait, one last thing.
Yep.
Again, for those that I was on earlier, and I was at the beach, the clouds came out, I went home. We are doing a trader meetup in Stamford, Connecticut on Wednesday at 7:00. It's at the Cisco Breweries, not the Nantucket one. It is the Nantucket one, but it's the Nantucket offshoot in Stamford. And so anybody that wants to come, there's free beer, courtesy of Stock Twits. So let's really go there. George, you're going, right?
Yeah, I'll be there. See you there, Tommy. All right, thanks for that time. We do Michael Green and then Jeff. Hey, Michael, what's up? Michael, you want to mute yourself?
I do want to unmute myself. Thank you, George. I apologize for that.
Hey, Ben.
I just sent Three Aces a couple of charts. I believe he posted them that perhaps will restore an element of your faith in humanity. The primary point that I would make is that a lot of the data we're getting on flows into Cathie Woods ignores the underlying dynamic of the introduction of an inverse product and the create to lend dynamic. So on my calculations, she actually is not taking in that money. There has been a small bounce, but that has been eviscerated in just the past couple of days. And what you actually saw in this dramatic underperformance was the start of outflows again.
Michael, I hope you're right. I fear you're wrong, and I'll tell you why. Because if I look at the TQQ thing, I haven't looked at it for a week or so, but last I looked a week or two ago, that had taken, I don't know, $6 billion year to date or something like that. Didn't see any outflows there. It was money
So
in.
the thing you always got to be careful with, right, is you've got to combine short interest and the flows. If there's a net order imbalance to short, the specialist will actually create shares to lend shares. So you just got to be really careful in the interpretation of this stuff.
I totally get what you're saying. So my question to you is, it's beyond my pay grade. So I'm gonna turn it back on you and say, can you? It's not can I prove they're sending money in. I'm gonna put it back on you and say, can you prove to me, given how difficult it is it's a nuanced question, can you comfortably state that money has actually been going out of Cathie Woods and the Qs?
What I would very confidently say is that Tommy is correct, right? That there's money going in and there's money going out. The retail traders have not yet started to abandon ship, which is, of course, exactly the warning sign that you're talking about. You are seeing inflows coming in from places like Nico Securities, where she has distribution dynamics. And again, a lot of that, you've heard me talk about this before, a lot of that is things like structured products, because the high volatility of Tesla makes it super attractive in option structures. So and it's a known name, right? As bad as the research may be in the United States, I assure you it's even worse amongst Asian retail investors who are investing in structured products and see Elon Musk as representative of American ingenuity and talent and capability. They have even less ability to dissect his misrepresentations from the American public. So the quick answer is professional traders are continuing to add to shorts. That raises risk of a bear market rally, but at the same time, the net shares that are outstanding are falling.
Okay, well, that's pretty consistent with, I think, what we're saying at the outset, which is retail bought a shit ton of this stuff and they haven't sold anything. And it's, if anything,
I think that's absolutely correct. I do think that it matters. You have to disaggregate it in terms of
for sure. But it's the dumb money, the retail guys who are left holding the bag. I mean,
this is exactly why you hear me complain about this stuff. And again, I just want to emphasize though that the odds are very low that you're going to see that change in terms of individuals selling until the net dynamics effectively tied to employment shift against them. Right, because what you're seeing when somebody buys a Vanguard Total Market Fund, which is why, or the inclusion in the S&P 500, which is what propelled Tesla to the extraordinary heights in the fourth quarter of 2020. There's nobody who's being quote unquote dumb or thoughtful or anything else, right? They're just doing what their HR manager set them up to do.
No argument there.
So yes, it's dumb, but it's not. I would argue that there's less crazy retail participation than you think. On the Cathie Wood front, absolute inanity, right? Like that's just silliness. But Tesla itself has some very interesting dynamics associated with it that explain a lot of the behavior. Anyway, and with all that said, I agree with what everybody else is saying, Kantrowitz, especially in terms of the dynamic. If you want to talk about a similarity, right? This is functionally identical to what happened in the dot-com cycle, where stocks cratered, money-losing stocks, unprofitable stocks, et cetera, as it became clear that the money was no longer coming in. And then the recession hit after the rally from 9/11. And if you guys remember, like that was chaos. The summer of 2002 was brutal. Nothing worked. That to me feels like the next step in this market.
That's what we've all been saying.
Can I just tell you what it's like to see a meltdown in the market? I was in Japan in 1989. I mean, the people were just like, they couldn't believe that the stock market went down so much.
Motorhead coming soon to a theater near you. Michael, keep going, my friend. What's up?
The only other thing I just wanted to add is I just want to make sure that people, when we talk about fundamentals on Tesla, for example, like I heard the number that only 1.4 million vehicles are sold over 40,000. That's a hyper-dated data point. If I look at new car sales in the past year, in the United States alone, roughly 6 million vehicles were sold over $40,000. So like 45 was actually the median. So this is one of the challenges for Tesla Q is that, the facts on the ground are often slightly different than are represented. Just want to make sure that people, do their best job of putting their best foot forward on this stuff.
Michael, I just want to tell you that all the car makers in the world are making money on their used car sales because, Toyota, VW, all these big car makers have captive finance, businesses.
Yep.
And they're like totally making out like bandits. And so like the funny thing is that Tesla sells more volume every year since the chip crisis started in 2020. And yet the ICE legacy makers make more money than Tesla.
Again, I'm not arguing with any of that, and I'm not defending Tesla. I just think it's really important that when we present fact-based arguments, that the data matches what we're actually saying, because it destroys our credibility when we say things like there's only 1.6 million vehicles over 40,000, because that's just not true.
Oh, it is.
No, it's not.
Yeah, it is. It is.
The median price for a new car in 2021 was $45,000.
Yeah, and the starting price for a Tesla is $62,000.
But that's not the same statement. You said 1.6 million vehicles in total globally were sold above 40,000. That is not correct.
No, it is.
We sold 12.3 million vehicles in the United States last year. The median was 45,000. That tells you at minimum there were 6 million vehicles sold over 45,000.
I'll send you the data. Look, I mean, I'm an auto analyst for like 25 years.
I'm not disputing that.
Hey, Michael, are those passenger vehicles, or does that include
those are passenger vehicles?
Mack trucks,
yes.
And all that stuff?
Those are passenger vehicles.
Okay.
Of course, it's passenger.
Could I suggest we follow up? We're getting into the Tesla discussion, which
yep. No, and again, my point was actually just to highlight the dynamics that the flow is not as simple as it appears. Yes, the shares outstanding in ARK have risen. That's a combination of shorting and the introduction of products like SARK, which needs to source shares in order to be short.
Fair enough. All right.
I'm going to step down.
Thanks, Michael. All right, so let's hold it right here for a second. Reset the room. Guys, it's an unbelievable room. 3 Aces, Tommy Thornton, Michael Kantrowitz, Motorhead, just Mark Newman. What an incredible room. So we're going to go with Jeff Carbaz, and then following Jeff, we've got London calling. We have Michael Howell joining us. Good to hear from Michael as well. So we're going to do Jeff Carbaz and then Michael Howell. Jeff, good to see you. What's up, my friend?
Hey, George. How are you?
Good. What's up, man?
Okay, so first, when I was listening to all this stuff, I took the song Playing with Fire and I modified it in a way in which I thought you would like. So I think we need a little humor after that last little thing. So mind if I give it to you real quick?
Go for it.
Well, you've got your Teledoc and you've got your Coinbase and the chauffeur drives your Tesla. You let everybody know, but don't play with Noble because you're playing with fire.
All right, man.
I do have a second stanza, but I will save that to publish onto to Twitter after I create the third and final stanza of playing with fire.
So,
okay.
So Jeff, what's on your mind, my friend?
So first thing is we got to short interest yesterday. And I want to talk about it as it relates to Stan's comments. But the first thing is the most important thing for people to remember is that the most important technical indicator is bias. And bias simply tells you whether you want to be long or short. And we have a particular way of doing it on a monthly, weekly, daily basis. The monthly is really important right now, because all the sectors have been negative for multiple months. And the longer we go, the more it starts looking more like a 2000 to 2002, an 07 to 09 event, rather than a 2011 or 2015 event. So I think that's a really important fact for everyone to understand. And to like the point that Stan was making about not being short right now, is you can have these rallies that, quote unquote, rip your face off. I think that's a direct comment of what he said. And George, you can relate this back to our comment before you went away. We're talking about this idea out of Erlanger, which is tracking the type fours, which are weak stocks that no one is short. And they started going down week after week after week. And we got to week 6. And since 2009, there had never been another period where we'd gone more than 6 weeks in a row before the type fours then had a rebound week. And you scolded me a little bit, rightly so, that you're basically data mining. And I said, yeah, I am data mining. And then the following week, we got the rally. But here's the kicker. It was only a 3-day rally. And the first rally we got this year was from March 14th through March 29th. It was a couple-week rally. It looked a lot better than what we got 2 full weeks ago. And it only lasted 3 days. And yet, that was the week into Memorial Day weekend. The S&P gained 6.84%, but it was really, a lot of it happened that Friday alone. And then last week was a good week for long short. The short squeezes were up like 4 basis points, and the long squeezes made 1.84. This week, everything went down. It was like a flat week, which, when you get a really bad week like this week, just alone on Thursday and Friday, we lost 5.21% on the S&P. So we're in a mode where everything is kind of falling. And what's interesting to me is the intraday kind of matters here a little bit. And I equate I kind of compare this to Top Gun, where they get told not to go below the hard deck. Well, we had 9 trading days in a row coming into the latter part of this week where we had been trading basically 415 to 410 on SPY. And then we broke the hard deck at 410 and bye-bye. And now we're in the 390s, or actually below 390, 389. So I think that's a key thing for people to remember. Back to short interest, we now have 9 sectors from 6 out of 24 that have short intensity above 50%. So the short interest is rising, and that's probably a good reason why, Stan's like, hey, I'm gonna go to the sidelines for a while. And as Tom said, let the market kind of rally and then re-put on shorts after that thing, takes care of itself. So that to me is like, be very aware of. Energy, it's pretty amazing. I just put a chart up on Twitter. We're at 23% of all energy names in a short squeeze now. So we had the run up. I mean, George, you remember when you started this, we talked about the fact that people had started shorting energy in January and February. And then we got in April, we got a little bit of covering. The overall short intensity for the sector went down to 37. Now we're back to 42. So we've gone up in like the last reporting period by 5%. It's still the second lightest shorted sector because so much other stuff is being shorted, but it's still enough to matter because 23% of energy stocks being in a short squeeze. Exxon just, went from 1 and change to 2 and change. It was a big absolute number. So it's an interesting comment that people are playing with energy again on the short side. Couple other key points out of the work right now. The flows in stock. We have a thing called the Erlanger volume swing indicator. And basically, we've been pretty much negative all year. We got back up to positive 2 weeks ago. So right after Memorial Day weekend, we got to a +1. And now we're back down at a -7. And so it seems like, to bring in another song, Pete Townsend, Crashing by Design. It seems like this is what the Fed is basically creating. And there's 4 nice lyrics from that song. It says, nothing must pass this line. We can talk about interest rates unless it is well defined. You just have to be resigned. You're crashing by design. So, George, I feel that theme is a really big theme for where we are right now. We're kind of crashing by design. And a lot of people, especially mainstream media, are very ignorant of it. One thing in our weekly report that we put up is year-to-date stats. So far through the end of May, I'm going to calculate it this weekend again because I'm curious after Thursday, Friday. Only 21.83% of stocks were higher for the year. Here's a great stat. I always like to look at on the positive and negative side, how many stocks are up more than 50, 25, 10, and same thing on the short side, down 50, down 25, down 10. So through the end of May, 197 stocks were up more than 50%, and there are 862 stocks down more than 50%. Now, this is out of the full stock legitimate universe, which is roughly 5,400 stocks, and up more than 25% were 385, and down more than 25, 2,084. That is a really telling statistic. And then just the overall up was 1,187. Overall down was 4,199. So
Jeff, let me just interrupt you for 1 second. So I'm hearing, because you get in the weeds on this stuff, what I'm hearing from you is it just sounds really negative. And then my question to you is the leading question. When you have a setup where something, quote unquote, should happen, or the odds favor that it should happen, and it doesn't happen, what does that tell you?
It goes back to like what Phil says. Pay attention to how stocks react as opposed to the news and how they react. What matters more is like how they're reacting to stuff.
So with respect, just the interest of integrity, he obviously was a paying client of Stan Weinstein, who invented that phrase. It's not the news, but the reaction to the news that counts.
Exactly.
Okay. By the way, FYI, break-in. I think someone mentioned this before. As we're sitting here, it's not just that Bitcoin's down 2.7%, but Ethereum, someone mentioned an hour ago, now I finally looked at it, it's down like 8% right now. So you look at that chart, I mean, Ethereum's 1530 last. I mean, even an amateur chartist, I think, would say this is going to 400. Bitcoin, my long-standing target's 11,000. So anyway.
Yeah,
says Jeff, so out of all that, for the 1,100 people, and this is a massive, massive room, one of the best we've had in a long time. I just can't believe it. We have Anas Alhajji, Michael Howell, Tom Thornton, yourself, Michael Kantrowitz, Michael Green, Newman, Three Aces. I mean, Mark Cahotes. I mean, show me another room that comes remotely close to being like this. So, Jeff, what is your advice for the average person in the room?
Have a lot of cash. Unfortunately, I think he's wrong on this. I mean, Ray Dalio, the idea that cash is trash, that's totally not correct. And individuals can wait it out until this gets over and done with.
100%.
What's most interesting in our work, there are only, and I'm just going to go look at it right now, but I believe it's 2 sectors that are positive. Basically, we rank everything, so we have to do a full ranking system. But the only 2 sectors that are positive now are energy and utilities, and that's kind of it. And utilities are kind of waning a bit, but they're still kind of hanging there.
Yep.
So the way we try and do it, and it's still been hard because we have to do a list every week of our favorite longs and our favorite shorts, is just to try and be as defensive as possible on the long side. I.e., this last week there were 0 tech names there, and there haven't been tech names.
And Jeff, last question. I want to get Michael Howell in here. If one was going to be shorting, I know you're always a big proponent to go where the weakness is, but you don't want to get caught in the squeeze. But so what sectors would you be looking to be short? I mean, I think fundamentally, you may say it's too much of a squeeze, but fundamentally, I think the consumer area looks great for shorting. That's just a fundamental call.
Yeah, well, our I'll just tell you our short list. It wasn't very big. It's 8 names. So Simon Properties, so I like REITs. We also had KKR Real Estate Finance Trust, which is KREF as a short. Walmart was a short, and we put that on Monday, and then obviously the Target thing happened later in the week. Bank of New York, Deutsche Bank, which totally fell apart this week. As a matter of fact, we made so much money in it this week that we took it off on Friday a little earlier when the market was rallying. I think we were up I think it was like 14% on it. Church and Dwight, standard, slow, but it's just struggling.
All right, but Jeff, just with sectors,
yeah.
What is it? Consumer? Is it REITs? What are you saying sector wise? Where you'd be looking for shorts?
REITs, financials, consumer, and then healthcare equipment.
Awesome. That's awesome. Jeff, please stay on stage. I'm sure there'll be more questions for you.
Okay.
So I'd like to go now to, oh my God, what an incredible room. So Michael Howell and then Dr. Anas Alhajji. Michael, my friend, good to talk to you. It's been a while.
It's been a while, George. Hi.
Yeah, you're unfortunately, you've been right as rain. And again, I maybe you start to get sick when you hear my gratuitous praise of you in my tweet. But I can't think of anyone who's gotten the big picture more right than yourself. And so, much deserved shout out to you, my friend. Maybe give an update to the folks in the room. What are you thinking? If they're paying attention to your Twitter account, it looks like the song remains the same. But just give us kind of an update to what about your thought process right now.
Sure, George. Well, thanks for the compliment. I'm also going to go back and pick up a comment you said, where this market looks a lot like Japan, and you knew a lot about Japan. And I remember back in, I think it was the early 90s, going into your office in Fidelity, and you had on the wall a poster, and that poster was called, if I remember, From Ptolemy to Copernicus, issued by Nomura, correct?
How? Holy shit! I have that in my study right here.
Yeah.
I'll take a picture of it and tweet it out. Good.
Right. You want to do
that? Good for you, Michael. Good for you.
That was denial at the time by people that you would have thought was serious, like Nomura. They just denied the market bubble. And we've got another one. I remember what happened in Japan in 1989. Mieno, who was then the equivalent of Jay Powell for the Bank of Japan, made a statement and said, "We're going to kill service sector inflation." Now, I was at Salomon Brothers then, and we were scrambling around trying to find out what service sector inflation was in Japan, because on paper, Japan didn't have any inflation. But Mieno started the squeeze, and boy, that was a serious squeeze. And no one's really been mentioning the Fed in the last hour, as far as I can recall, on this chat. But the Fed means business. And we put a little diagram pretty frequently on our Twitter feed, which is at Cross-Border Cap. And that tracks not the Fed balance sheet, but the effective Fed balance sheet. In other words, how much liquidity the Federal Reserve sticks into US money markets. And the S&P has tracked that absolutely one for one with about a 4-week lag. And if you look at what the Federal Reserve intends to do, which is to take $2 trillion out of the balance sheet, the market's got 3,200 written all over it. If the Federal Reserve makes a mistake and allows reverse repos to pick up, which is quite likely, because this is a fairly wonkish fact, but if they start pushing rates up, money market funds will put their rates up faster than banks. There'll be an exodus of money into the money market funds out of bank deposits. Reverse repos will spike, and you might get the reverse repo, which is currently 2.4 trillion, up well in excess of 3 trillion. So in other words, that's money out of the market. So in actual fact, the Fed may want to take 2 trillion out. They end up taking 3 trillion out. That way, the S&P goes to 2,500. So that's how bad it's going to get. We've only just started this thing, and I think the best place is cash. The only thing I'd say is that we're nibbling at the long end of the Treasury market. It may be a tad too early, but you just don't know. And there are two things that make us, maybe a little bit nervous on that bond call, and they're both international. One is what's going on in Japan and the weakness in the yen. At some stage, the Japanese are going to say, enough pain here. And they're going to start changing their yield curve control and allow the JGB bond to trade up to maybe 50 bips. And that's going to put an earthquake under the market. And the other thing is just take a look at the German Bund. That looks to me like it's breaking out. Yields are going up. And that's a really worrying sign. The Europeans have just lost control of pretty much everything. And I wouldn't want to be in the European markets at all. That's where you've got some really big overweights. The US may be overweight risk assets, but believe me, Europe is too.
Yeah, Michael, that's brilliant. Maybe you could just flesh that out a little bit more. I'd like you to speak, please, because you always speak to how volatility, starts in whatever it is in fixed income and goes to currencies the other way around and finally to equities, but how that all works through. And then specifically in that context, you rightly mentioned the bund yield starting to move. But what do you make of the fact that the yen is trading like, the freaking Argentine peso or Turkish lira? And what are the implications of that for global markets?
Well, let me go to the yen first, because in all the years I've been in markets, which have been a lot, I've never seen a currency weaken as rapidly, a big currency as rapidly as that. If you look at 40 trading days from early March to early May of this year, the yen devalued at an annualized rate of 83%, right? Markets don't do that. Only governments do that.
Stop. 83%. Hold on.
At an annualized
83% rate, and this is the world's biggest creditor nation.
Yeah.
Did I get that right?
Yeah,
okay,
absolutely.
Can you?
Markets don't do that. Governments do.
Mic drop. That is okay. Keep going.
So this looks like it's an attempt to do something. Now, it's either the Japanese trying to steal a march on the US. I doubt that, because I think there's been no complaint from the US Treasury about what the Japanese have been doing, or it's an attempt to shake the tree in China. And, I think it was Winston Churchill once said that if you're going to kick somebody, kick them when they're down. So maybe the best time to kick China is when China is reeling after this COVID-19 problem. And they're doing, I would suspect, is if you get the yen weakening at this rate and the Korean won has weakened similarly, they're putting huge pressure on the Chinese yuan. It's trying to weaken through 7. The Chinese are holding it back, but in trying to hold it back, they're squeezing their money market significantly. Now, normally, April and May are big months for the People's Bank of China to stick liquidity in their market. They've actually taken out somewhere close to 800 billion yuan, which is about just over 110 billion dollars out of their markets in the last 2 months, which are normally big liquidity inflow months. So this is what they're doing, and that is going to have a negative effect on the economy. So what you're looking at is, global recession. And to pick up, I think it was your point earlier on, if the Fed is crucifying the PE in the market, it's the Chinese that are going to kill the E, because they are the elephant in the room when it comes to industry. So that's what I would say on that. On the on the European situation, on the Bund, I think the problem you've got in Europe is that there's been denial for a long time. The Italians take on an awful lot of debt, and the Germans will never admit liability for that debt. And conveniently, the COVID-19 crisis allowed the ECB to paper over the cracks with lots of liquidity. Now that tide of liquidity wants to go out because of inflation. You're going to get a lot of tensions in the European bond markets, which is already starting. Look at what happened to Italy this week. The issue that the market's saying is that they don't believe that the ECB is going to be tough enough on the inflation fight, and that maybe is why the Bund is selling off. But if you've got the JGB potentially going up and the Bund going up, the US Treasury 10-year is also going to come under some upward pressure. So although I'd be nibbling at that market on the basis of recession, that's in the background in my mind that may go wrong.
Michael, could I ask you a slightly different question? So I have a lot of time for the folks at GavCal. Louis Gav, quite a good thinker. I don't know how well you know him, but they've been on this kick in the last few weeks, and I mentioned it earlier in the room. I don't know if you were in the room at the time. And there's a very good podcast. I suggest I'll send it to you. And he was speaking about deglobalization of financial flows, deglobalization of trade, we know, but deglobalization of capital flows and the attendant consequences for interest rates in the United States and Europe. That if you've basically dating this all from what's happened in Ukraine and Russia and the U.S., denying Russia access to their billions, and the idea that economic actors who had money, say in China or emerging markets, who heretofore would have kept them in the U.S. banking system, and they'd find their way into treasuries or real estate or U.S. equities, then all of a sudden that's not such a no-brainer trade anymore. And the argument basically was that those flows those flows will go elsewhere. So ceteris paribus, that would mean higher real rates in the U.S. I don't know how familiar you are with the theory. If you think it's bollocks, or I think it's the way you folks say it.
Yeah, I don't buy into that. To be
okay, could you please explain why you don't buy into that?
I think the reason will be is go read Janet Yellen's speech. I think early April to the Atlantic Council, and then listen after that to Blinken's speech about China. And what you're getting is the Yellen speech was called friendshoring. I don't know if you've come across it, but what that basically means is you're either a friend of the US or you're a foe of the US. And that is now becoming stark. And one of the things that people have been talking about recently, you may have heard this, Bretton Woods 3, Bretton Woods 2, or whatever. Actually, we've never left Bretton Woods 1. Bretton Woods 1 was all about the dominance of the dollar. It was about creating a system whereby you could move trade and capital around the world, and the dollar was the center of that. We had the IMF and the World Bank policing that system. US credit became dominant, but as an aside, we had fixed exchange rates. The only thing that has changed in that whole equation has been fixed exchange rates. And actually, you can say that fixed exchange rates are sticky, not necessarily floating right now. So that's the only change. We're still with Bretton Woods 1. The dollar is dominant, and the Bretton Woods 1 was all about circulating capital and trade in the free world. Remember that the Soviet bloc and China were outside of that. That's the world we've come back to, and this is the world that you're now looking at. And so I think that this is, this is the new world. It's all about friendshoring. Who's your friend? Those are the countries that will get access to dollars. And the Fed, the reason that we're focusing on the Fed so much is that in the last 10 years, the Federal Reserve has increased its power enormously. The Fed was sort of almost off the map in the GFC. They lost control of the US credit system. Now they've muscled back with lots and lots of different programs like foreign exchange swaps, like the standing repo facility, regulation of banks, all this sort of stuff. The Fed's about 2 to 3 times more powerful than it was in 2008. And what that means is that you've got to start listening to what the US is doing. And if the Fed is trying to create a squeeze in the global economy, which may be what their agenda is, that will clearly help to get US inflation down as well. You want access to dollars. And the Fed is the tap which turns that dollar tap on.
Hey, Michael, George, you mind if I ask a quick question?
Go for it.
Or you want to keep going? So, hey,
no,
Michael,
no,
I'm just curious.
Go for it.
Yeah. By the way, Dr. Anas had to step out for a TV interview. He'll be back in 10 minutes. Michael, I'm just curious now. If the Fed and the U.S. is tightening, but we don't see a commensurate level of behavior internationally, is it possible that the dollar can just continue on this bullish run that it's on because of the excess liquidity in foreign currencies coming into dollars that are shrinking? If that's a real question, thank you.
Yeah, it's a real question. The real answer is yes, and that's what's going to happen. I think the policy of the Federal Reserve and the Treasury is very simple, and that is to get the balance sheet down and the US dollar up. And that's what's basically going on. And the more the dollar goes up, the more you get a squeeze in the international economy, and the more these foreign governments have to go back to the Federal Reserve to get more dollars. One of the things that changed under the Trump regime because of various tax changes is the euro-dollar markets have become a lot less important than they were. It's really the Fed now that supplies a lot of that offshore liquidity. And if you need offshore liquidity, and just remember, in the last 10 years, there's been a huge amount of borrowing in dollars and a lot of FX swap business done. And the Federal Reserve will bail out the global system if it decides you're a friend of America. And that's why I think this friend-shoring speech by Yellen is so important.
So we need to get long cross-currency based swaps, right?
Right. So, excellent. So, Michael, so you're basically advocating people just be defensive, hold cash, and hold that cash in dollars. Is that your message?
Yeah, I think dollar cash is the best thing to look at. I buy into your argument for oil. I think there's a structural deficiency in oil, particularly in Europe. As I say, I'm nibbling in the long end of the Treasury market, but I fully accept I may be too early on that one.
And not that it really matters, because we're more. So I don't want to get into a debate about recession, no recession, but at the end of the day, we're interested in asset prices. But in the for what it's worth category, how is your probability assessment of recession in the U.S. changed? I mean, you spoke about different levels of the market, whether it's just a slowdown, recession, or banking crisis, and the market will go down certain amounts, whether it was 20, 30, 40%, whatever. Where are you? Where are you in terms of your thoughts about recession versus slowdown, and what does it mean for markets?
I think pretty clear. I mean, look, Asia is in recession now. Europe is probably just entering, and I think the US is about a month behind. So I'd say that the recession is on the horizon. Just look at the earnings statements that came out of Target, Walmart, and Abercrombie. Everybody's saying inventory levels is soaring. I mean, this has got recession written all over it.
Right. So slowing. So do you think inflation ultimately comes down only because we have a recession? I mean, this sounds like a horrible cocktail for asset prices. You got a slowing economy, if not recession. And I think what I find most alarming is the point you were making about, and we were speaking about this earlier, perhaps before you got in the room. Don't fight the Fed. The Fed wants the market to go down.
It's it. I mean, the point is that if you look at the people are asking the wrong question about inflation. They're asking it this month. Has inflation peaked? That's not the right question. The question is, when does it come down to a tolerable level? And that's going to be months and months and months away. The level of persistence in inflation numbers in the US is back to where it was in the late 1970s when Volcker was appointed. So it's going to take a big squeeze, and the Fed is intent on front loading that squeeze. So the next 6 months, there's a lot of stuff going to hit the fan.
Wow! Just when Michael, just stay there. I'm sure we're going to have some questions. I'd like to go to Brian. Brian, do you have a question? Brian, please unmute yourself, Brian.
Yeah. Hey, George. I just actually wanted to make a quick comment about something that was made earlier about retail not selling yet. So it's actually funny at work. My colleagues, I'm an engineer, and they constantly are looking at the market and commenting on it and saying like, oh, the market's down, time to buy. Well, it was funny because yesterday, actually, one of my colleagues changed and was like, oh, shoot, I lost $10,000. So, yeah, it's starting to get a different vibe out there, and they could be capitulating soon, I think.
Thanks, much appreciated. Okay, let's go to Jeffrey and then Brian. Jeffrey, you have a question?
Hey, George.
Hello?
George, can I just jump in? I got to run. Can I just make a couple of comments real quick, if you don't mind?
Only if they're relevant to what we're speaking. If it's something irrelevant, no.
Yeah, definitely.
In other words, I don't want the thread of this conversation changing. So go ahead.
Definitely. Yeah. So I think I would say the financial system is highly manipulated. I just posted one thing up in the Nest. If you just look at it, the M2 money supply increased 40% in 2 years from COVID. So this shows that, they've printed a lot of dollars recently, and that's where we see the financial system. I think, the Fed is in a rock and a hard place right now. Our debt to GDP is 130%. So they have to inflate that debt away. Going forward, with the high inflation print, 8.6%, I think the next 2 June and July interest rate hikes, I think they're locked in at 50 basis points, because that's the most pressing issue, is they need to get inflation under control. But I think the ceiling for how high the Fed can go is about 2%. So they don't have that much room to go because of our debt. It's so high. So I think the currency printing will continue down the road. So I think as soon as there's some good inflation prints going forward, they're going to back off and then continue. And I think you see this. US is 130, and I think the world is at 250% debt to GDP. So this is where I see going forward, they're going to continue to manipulate the markets, and they have to print. And yeah, everything is overvalued. Yeah, like you say, George, that this is a market is a everything bubble, and I can see that from all the currency printing.
Do you have a question? Otherwise, I want to move along. Do you have a question?
No. I just wanted to comment on that. What you thought about that they have to continue printing. Would you agree with that, George, given the debt to GDP?
No, I don't agree with that.
I don't think so. Because 2 is just their anchor.
Yeah,
Two's not locked in. They can raise that.
Listen, they are not in control of anything. They're behind the curve. They're following the market. They have no plan. They're reactive. I think people have too much confidence in them, and they think they know what they're doing. So no,
Barclays is trying to price in a 75 basis point for June. And someone else was saying that he should roll forward the 50 basis points from July and raise by 100 next week. Yeah. So, I mean, they left the door open for them to...
Yeah. Amy, you have a lot of feedback in the background. If you could just hold it until you're in a quieter place, appreciate it. We got a ton of people here who want to speak. If I don't know you, please, I've sent you a direct message. I want to know your question because otherwise, it was such a big room. This room is going to go off the rails. I want to stay on point. So if I've not recognized you, you need to answer. You need to respond to my question as to what you want, what you wish to speak about. Again, I'm doing this for the benefit of the room. Otherwise, these rooms get totally screwed up. I'd like to now turn to Gilberto, my good friend Gilberto. He's always insightful. He's got something interesting to say. So, Gilberto, long time have you been? What's on your mind, Gilberto?
Hi, George. Hi, everyone. I was wondering if any one of the speakers has anything to say about the price action in Chinese tech companies last week. Baba went to 125, KeyWeb rised, and we saw a relative strength toward that sector. And I want to know if there's any update in the Chinese macroeconomic environment that I am not aware of, or if this is just relative strength versus US CPI and the fact that in September we have that big political event in China, the confirmation of Xi Jinping. Anything anyone has to say about that?
I personally, let's put it this way: you can't get them all right. I mean, I've just been ignoring Chinese equities. Period. Missed the whole down. Now they're bouncing. There've been a lot of false starts. They may still go up. It's just I'm just not in a world where I'm negative on risk pretty much across the board. Yes, these things are oversold, and yes, they can go up, and yes, people are putting on a long Chinese tech trade versus short Nasdaq or Cathie Wood. Yes, 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 yes. But do I want to buy those in an absolute sense for my own account? No. But I'm going to now turn to Tommy Thornton, who I'm sure has a better opinion about it than I do. So, Tommy, thoughts?
Well, there's a couple things that are happening. And one is partly you've had some reopening, and I know that Shanghai just did another lockdown of some sort, but things are starting to open up for the most part in China, and I think that's partly why some of these stocks caught a bid. I also think that the Chinese government has been at war with the tech companies, and they've sufficiently brought them to their knees, and now is starting to lighten up some of the rhetoric. And I think the Ant Financial IPO is going to happen, and I think that's going to, the several reports where it's going to happen, and then the government squashed it a little bit. But I think for the most part, it will happen, and maybe this year. I mean, maybe next year. But this is going to be the largest IPO ever. It's going to be absolutely monstrous. And the other thing is, everybody's talked about how uninvestable these companies and the whole sector has been. I think that's starting to change a bit, and it's not necessarily the low risk type environment, but some of these companies like Baba are fairly cheap. And if you're looking for a cheap upside potential play, I think that is possible. Now, there's another problem that could happen is if everybody's favorite Japanese company, SoftBank, really has to take down exposure, mark things down, and then have to sell some Alibaba because of all the leverage. That's a potential problem. But for the most part, it's the thaw. It's starting to thaw out a little bit in the group, and people are looking for different places outside of the U.S. and places that have been beat down with some upside catalyst. And I think the reopening story in China is one, and if the government stops the war on tech, that's another. So it's the game, approval of games is happening as well, and that hasn't happened for I think over a year. So there's some improvements there. So that's all I've got on that. And
Thomas, if we're all sort of somewhat, we are all bearish, isn't this also just a sort of classic bear market rally? I mean, for all of the reasons you say, the supply chain disruption. I mean, the point about inventories that was made earlier is spot on. Everybody is desperately trying to wind down their forecasts and their commitments, canceling POs, especially in the consumer electronics industry. I sort of see this as goodwill factor, markets, the manufacturing open up, the lockdowns sort of being eased. You're right, there are some restrictions in Shanghai. But as this filters into consumer sentiment, cost of living crisis, all of those inventories that globally retailers are holding on to, I'm seeing 30% across the board, people trying to cancel purchase orders, reduce their forecast because they're carrying too much inventory. And when that catches up, then there's another leg down for the Chinese market, because then demand will significantly drop. And the last 2 years, China has been ramping up demand, especially on the electronics side. If you look at semiconductor, maybe not at the high tech end, so the sub 12 nanometer second end, but they brought on 20% more processor manufacturing fab capacity from 18 nanometers up in the last 18 months, 2 years. So I sort of see this as like a bear market rally, and by the end of the year, you'll see all economies, and that will impact China, because that, as George has said, is where most of the world's goods are still manufactured. I mean, obviously you've got Philippines, you've got India coming on, but if consumer demand has dropped, if they can't afford these products, then that's a massive.
Well, I don't doubt that this is a bear market rally. I just think that people are looking for spaces that have some potential catalyst for a little upside. That's it.
All right. I'm stopping this line of discussion because we all in agreement on this bear market rally. That's it. These are trading sardines, not eating sardines. I want to keep this moving because we got a lot of people. Got a huge stage here. It's been a great room. I just want to keep the pace up. Chris, Master John has been waiting patiently. Chris, we're going to go to you, and then we're going to go to Shrub. Chris, what's up?
Hey, I intended this for a question for Michael Howell, but I think he's gone. So it's a question on the bond market. Maybe someone else can take it. My question is, part A is there a risk in the sum, like in a 1 or 2 year time horizon, that the Fed would have to reverse specifically because there would be a sovereign debt crisis without them reversing? And part B would be, if that were the case, would they just like step in to buy the very long end of the curve so that selling off the like 2 to 5 year bonds would hurt corporate refinancing and bring down the economy in the way they want while still funding the government?
That's an interesting question, but honestly, I'd rather not go there because
All right.
I have an opinion. I have an opinion about that, but I don't want to go there because that's really, I think, taking us. It's a great question. I'm sorry you didn't get a chance to ask it before Michael was in the room, so no disrespect intended, but that's going to kind of hijack the direction of this room. I really don't want to go there. I don't think it's relevant right now. So thank you for the question. Please, in another room when he's back, please ask it. Hey, Shrub, good to see you, my friend.
Hey, buddy, how are you?
Hey, good. Shrub. Speak flows to me, baby. Speak flows.
Let's talk flows. So, in case you're wondering why the market sold off 3.5% on Friday while everyone is bearish and everyone is uninvested, the answer is because everyone is bearish, but everyone is still invested. It's like,
Shrub, you crack me up, dude. The thing is, every week you can't make this stuff up, Shrub. Shrub. I'm just gonna sit back and relax. You have at it, Shrub.
So that's why I put this meme that I did last week, and actually I made money out of this meme. Is like, so basically, every Wall Street strategist, smart guy, options guy was saying, "Oh, you know what? You got to be bullish because there's a big option expiry next week." So I was sitting back and thinking, okay, so you're telling me I should ignore the central bank rate rise? I should ignore the CPI. I should ignore the recession. I should ignore Target's earnings, but I should be bullish because of an option expiry next week.
Bro. Didn't you hear Cramer, bro? Hey, bro. What about you? Hey, bro.
But anyway, I think people just look for a narrative to burn money. I think the banks are just trying to build narratives to burn money. So I'm predicting that next week you will see another silly narrative that the market will go bearish into the Fed, expecting 75 bips. Then the Fed will do 50 bips. the market is going to say that it's a dovish rate rise of 50 bips. They're going to ramp it up and then it's going to puke again.
Hey, Shrub, question
Yeah.
for you. How you doing, my bro?
I'm good, brother. How are you?
I'm doing great, thanks. Quick question for you. In a rising dollar environment where commodities should be under pressure, we obviously have this, the supply-demand imbalance in the oil patch. Now, I'm just curious, what if I'm looking at oil stocks here that are, hemorrhaging cash, am I to value them as growth stocks, or am I to value them as value stocks? Can you talk a little bit about that, please?
I
Thank you.
think you evaluate them as stocks that are going to save you from a stagflationary environment like they did in the 70s, and that's exactly why Buffett is buying them today. So they are in an energy crisis, you want to be long the energy. In a stagflationary environment, you want to be long the energy. So that's why now I'm more than 50% cash, but my remaining exposure remains energy. And actually, I have a new position that I can discuss later. I went back to fertilizers. So not to be only bearish, I actually found that this week had a good opportunity on the long side on fertilizers, which, to be honest, I mean, there's a byproduct of energy in some way because you need energy to make nitrates, for example. So energy is still tight. There's smarter people on this panel, and you've gone through it extensively, but it's still tight. The companies are still paying very high dividends. They make high free cash flow. So again, keep it simple. There's companies that make, there's there's some guys that can make more than 10% payouts this year. Some fertilizer companies make 20-30% free cash flow yields. That's going to stay high. So I want to be protecting my, what little exposure I have in the markets by having companies that actually make money. I think it's as simple as that. There's nothing nothing complicated. But I want to talk about the flow data as well. Now that I'm here, George, if you don't mind. So just on the flow data, what has been extremely shocking was that end of May, the week of the last week of May, we had 20 billion of inflows in equities, 20 billion in. And then last week, so this week, we had 12 billion in equities, of which 14.4 billion were in US large caps. So again, I want to continue how I started the discussion. If you're wondering why the market is getting killed on bad prints, it's because people are long. It's very simple. I think you said the comment about Stan Weinstein. It's like, see how the market reacts on news. So you had bad news and the market is down 3.5%. What does that tell you? It tells you that people are not invested? No, it tells you that people are invested.
Shrub, you've been at this for a long time, and just listening to you talk, it's when I can stop laughing. On a serious note, I listen to you talk, and you and I have a similar view of the world. I watch the markets. Don't you feel like we're living in a parallel universe? It's this sort of George Orwell type of world where the bullshit you're hearing, the narratives from the street and CNBC and FinTwit, it just doesn't match. Or as Three Aces would say, Three Aces, how do you say it? The curtains don't match the drapes, or whatever your line of saying is.
Yeah.
I mean, Shrub, something's really wrong here. Don't you want to just bang your head against the wall, Shrub?
No, I agree. I think it feels like we're living on a parallel universe. Like I read some comments, I'm like, are we looking at the same data? Are we looking at the same numbers? Why are people trying to buy the dip on mega tech, for example? We have CPI of 9%. It's so obvious what's happening with the Fed that the Fed can't do anything right now. The Fed is trapped. We know that they want to print, but they can't print, right? So it's just a very simple thing. Don't fight the Fed. The Fed is, the Fed has to tighten. They have to kill inflation. Michael Howell said it very well. It's not something you kill in a month. It's something you kill in a few years. So I don't know. I'm going to repeat what I did because I think it's quite important. So I've been a big advocate of cash. I'm more than 50% cash now. But for the first time this month, I actually took money out of accounts. So I took out and X% from accounts. So I went a step further because I actually think, and I did this for my own protection to prevent from doing anything stupid, but I think the next few months are going to be very bad. Summer liquidity with a hawkish Fed. Oh my God. I mean, Michael Howell was saying about 3,200, but possibly 2,500. But in a vacuum, if you have bad numbers or something happens in the summer with a very bad liquidity, I don't really want to be there. So we have a few bad months, but I have a feeling that we're still heading for the 2002 scenario. And a friendly reminder, 2000 wasn't a bad year. 2002 was the worst year. So 2000, the S&P was down, say 10. 2001, the S&P was down 12, whatever it was. But 2002, the S&P was down 22%. Because that's when the recession hit.
Yeah, shrub, 100%. That ties in with Kantorowicz. By the way, you're going to laugh. But I was listening to you talk, and you said, we're heading for the 2002. I'm like, wait a second. Meaning Shrub thinks the market's going, the S&P is going to 2,200. No, sorry. No, but we're on the. I mean, it's the Shrub. Let's argue against ourselves now, okay? Let's not because you and I think the same way. We like each other, whatever. So I get in violent arguments with myself. I know you do as well. So let's try to argue against our position. And you and I have talked this. We've had this discussion a few times over the last few months, and I still keep coming back to my conclusion, which is I struggle to find the plausible bullish scenario. As a matter of fact, the case for the bearish scenario becomes even stronger as we go along. So, if you and I we're at Oxford or Cambridge and we're having a debate, and you and I are teammates, and we're handed the bullish, we have to make the bullish case. Where would you begin to try to make the bullish case?
Oh, I'll start. The bullish case is that there's an option expiring next week.
Wait. You mean you started and you stopped? You began and ended with the option expiration. Okay. That's all you got, dude? Hey, bro, that's all you got, bro?
Okay, let's take each one by one. Okay, so positioning, which is what I look quite a lot of. So positioning, let's start with that. So everyone says positioning is bearish. I have the numbers. We've shown the numbers. $1 trillion went in since COVID. 20-30 billion came out, but actually we're getting inflows every week. So positioning is out the window. People are invested. That's one. Okay, fundamentals. Well, I mean, okay, let's say that the market P is 18 and it's 15, whatever, it doesn't matter. But actually you're having EPS cuts from major retailers like Target. So advertising is down the toilet. You have warnings from Snap. So fundamentals out the way. Oh yeah, so you have energy inflation. You have inflation through the roof. So obviously that's eating in margins. So fundamentals out the window. Then macro, Fed. Well, the Fed is trapped. They can't print. They can't cut rates. In 2000, don't forget, in 2000, 2002, they were cutting rates because there was no, right? They were cutting rates because there was no inflation after 2002. So here, they can't cut rates. So macro-wise, actually, it's the worst macro since the 70s because your star player, your Michael Jordan in your Bull team. So let's put it this way. So the market Bulls, the new Chicago Bulls, the market Bulls basketball team, your star player is the Fed, Michael Jordan, right? And you have Michael Jordan on the bench because you have inflation in the field. Actually, I really like that analogy. Someone should use it more. So, if you're playing against inflation, you can't use the Fed to play against inflation in a bullish way. So on the macro side, you kind of lost your star player, so that's done. The only bullish thing I see is that unemployment is actually quite low. And because unemployment is low, that again is reminiscent of 2000 because it encourages the Fed to tighten. If unemployment was high, you could have argued that the Fed would pause. But I think with unemployment low, that's my layman's view of the world it means that the Fed can keep tightening. So I haven't given you anything bullish except the option expiry so far. But look, like I said, so I'm not like a complete nihilist. Like last week, I did buy a decent position in fertilizer. So there's always something that's doing very well. It's just what's doing very well is not what people buy. People are still buying their fangs and techs and try to call the bottom in tech, whereas they're missing bull markets in niche parts of the world, in niche parts of the market.
Shrug, let me ask you this. We're going to have Dr. Nas Alhajji speaking of you, and then we'll have Michael K. Shrug, let me ask you this, because you and I have virtually identical views of the world. So a logical extension of what you're saying, I believe this, and I think you do as well, but I just want the audience to understand this. It seems to me, I think now is perhaps the easiest time in 15, 20 years to beat the market, because the index is so screwed up with all these growth stocks and tech stocks. The duration of the indices has never been great. Would you agree or disagree with that?
Oh, I agree 100%. I agree 100% because, the stuff that is actually working is less than 10% of the market. And we've been, everyone on this space, everyone on the spaces, you and the other participants, I mean, we've identified the winners over the last 6 months. So that's less than 10% of the market. And thankfully, we've been overweight that part. But that part is actually doing extremely well. I mean, it's doing better than it's ever done. So if you avoid the other 90% or short it, it's the best alpha you could have done. And actually, we should be grateful a bit to the ESG funds because they created this opportunity for us. I think the ESG created a massive ESG plus passive actually created this massive distortion that allowed us the opportunity to put probably the best long short trade in a very long time. Very, very long time.
Thanks for that, Shrub. Please stay on. We're going to go to Dr. Nas Alhajji and then Michael K. Anas, good to see you again. What's on your mind, my friend?
Thank you, George. Thank you, Three Aces. I'll start first with a political statement that has economic and financial implications for the U.S. economy and everyone in the market. Please, if you find some of the stuff I'm going to say shocking, yes, it is, and you better believe it. If you think Putin influenced 2016 elections, wait until you see the midterm and 2024 elections. Democrats and the Biden administration are desperate. Putin is playing a big game, way bigger than what people think. That is why Biden has no choice but to meet with the Saudi leaders, and probably get a decision on this within hours or days. So the meeting is going to happen, whether in Saudi Arabia or not. And will he get what he wants from the Saudis? I don't believe so. So you can believe the implications. I'm going to explain some of the issues here. China and Russia do not want this meeting to happen. Just to give you an idea on what happened in the last few days. President Obama gave a speech at Stanford on cybersecurity. Someone took part of that speech, cut it, and translated to Arabic. So it was intended literally for the Arab people and mainly the Saudis. And then a Chinese entity started promoting the video within Saudi Arabia and the Arab world. And the video basically is saying, in a sense, what the text that goes around the video and the implications is that whatever happened during the Arab Spring after, notice this, Obama visit to Saudi Arabia and Egypt, the Arab Spring happened. And Obama in the speech, in the video, is saying exactly how they ruined those countries and they removed governments and installed the new governments. And the message is, look, Obama visited you, and a few weeks later, you have the Arab Spring and governments be removed. And now Biden is coming to the Arab world, so expect the same. Well, what happened is Obama was talking about cybersecurity, and he was talking literally about Putin and Steve Bannon. So they removed the names, they removed the word Russian from the video, and they removed the American people and America and the United States from the video and made it look like as if he's talking about the Arab world. So you can see who has interest in this meeting and who has no interest in it. The fact is, political problems and political turmoil in oil-producing countries happen always during periods of high oil prices. We have only one incident in history where people think it was low prices. It really depends on where you start the bottom of oil prices. The other fact is, as oil and gas prices rise, workers I'm talking about the democratic countries here, workers will go on strike, leading to lower supplies and higher prices. So from the fact number one, oil prices basically might experience an increase because of political problems. Now, I want you to put this in the political context of the meeting of Biden with the Saudis. And with labor strikes, we already seen one in Norway will increase prices. Then you look at OPEC decision last week, OPEC Plus decision. OPEC decided to forward the end of the production deal from the end of September to the end of August. And therefore, they have this addition in September they need to deal with. So what they did is they divided that into two halves and spread that between July and August. And they increased the amount of the ceiling increase. The word ceiling here is important, not production. The ceiling increased from 432,000 barrels a day to 648,000 barrels a day happened because of dividing the September edition. And people look at this as this is an olive branch to Biden, trying to help him with lower prices. That's nonsense. The reason why, because we are not going to see any of the addition in the oil market. This is going to go to domestic consumption. Temperatures rise in July and August and September. They usually have something we call the power burn. That's when they need additional cooling, and they use fuel oil and sometimes crude oil to produce electricity. So we are not going to see that. That's another factor why oil prices might go up too. So you can see where Biden is coming from when he meets with the Saudis. And the idea here is the whole space today basically is about inflation and the role of inflation and probably recession. A rise in oil prices on its own does not cause inflation and does not cause a recession. I know there is a conventional wisdom there, especially among macroeconomists, that rise in oil prices cause inflation and recession. I can prove it easily without any problems. All you got to do is just look at the data without any bias, and you can see it. The problem is how the government and the Fed react to rising oil prices. Historically, if you look at this for the last 55 years or more, what you see is we ended up with high oil prices, then a recession because the Fed reaction, because of the government reaction. Otherwise, there is no reason to have a recession from high oil prices. Just look at the period between 2002 and 2008 to see that. So there is no problem here. I said Putin is playing a big game. Look at what's happening right now, and the media is ignoring that. All of a sudden, within 1 week, we have Kazakhstan announcing that they produce less oil, Saudi Arabia saying they are going to send less oil to China so China can buy more from Russia. Algeria basically is threatening Europe to cut natural gas supplies, and Algeria is an ally of Putin. So you can see the game he is playing around where he's literally tightening the ropes. So supplies are going to be less and less in this case. We ended up with two cases right now where we have fire in the United States. All of a sudden, you end up with, at the time, Algeria is tightening, Saudis are tightening, Kazakhstan is tightening. All of a sudden, we have a fire in an LNG plant. And it's a very large LNG plant in Texas, and LNG exports to Europe decline. And all of a sudden, at the same time, we have an interconnector problem in England that prevents the flow of oil supplies to the EU. So you can see what's going to happen to LNG prices and gas prices within the EU, and who is playing the game in this case. At the same time, China announced a new lockdowns. What China is doing, people say, well, this is going to decrease this is going to decrease demand. No, they are building their strategic petroleum reserves. They are preparing for the worst. So the situation, especially from a political point of view and its implications on the world, is getting worse and worse. Here is the irony. Russia is selling its oil at a discount that reaches probably $40. And who is buying it? China and India. And with China and India buying them, what they are going to do with them? If they fill up all their SPR, then what next? They have no choice. Well, they cannot buy anymore. And some people say, look, Russian economy is going to collapse because they cannot sell anymore. Absolutely incorrect. What we are seeing right now is India is rebranding Russian oil and selling it to Europe as Indian oil. China and India is selling products to Europe coming from Russian crude. And we are going to see more and more of that. Lavrov's visit to Algeria and Saudi Arabia is about swaps. His visit to Iran and the cooperation with Iran is about swaps. So we are going to see Russian oil probably even in the United States through those swaps. Who knows? The idea that we are going to have, despite all the bullish factors that I mentioned, the idea that Russian crude is going to decline substantially is nonsense, and therefore probably we will stay where we are. And in terms of inflation, we are going to suffer probably for a long time. And watch that visit to Saudi Arabia, because the Saudi reaction is going to play a big role in the Saudi economy. If there is some sort of a solution, Saudis alone can help Biden big time. Why? Because they own the largest refinery in the United States. And that refinery should have experienced a massive expansion as we speak right now, and that's been stalled. And that refinery, if they do the expansion one way or the other, whether petrochemicals or products, it can add 400,000 barrels a day easily for the next 30 years. So still, whether you like it or not, whether on crude front or the products front, the Saudis remain a big player here. Back to you, George.
That was a masterful review of the situation, Dr. Alhajji. Can't appreciate it more. So, net, I mean, I remember in our space a few weeks ago, you very carefully laid out the risks and the rewards. And I know we talked about the risks as well, which is we get a recession, a few 100,000 barrels, I think 400,000 of them through, might come off the market. Demand might weaken. So the oil price could come down, blah, blah, blah. Well, that was about a month ago. So what is sort of your current thinking as you've seen data points come along? Are you becoming more optimistic or less optimistic? Any change in view on your part?
No. Okay, let me speak in simple. In the short run, we have a completely unclear picture because we need more information about the recession and whether we are in recession, we are heading for a recession, whether we are going to have just low economic growth. We need more information. I know you and others basically believe we are already in recession. If we are already in a recession, we are going to see a decline in oil demand. We might see lower prices. If prices decline substantially, we are going to see a reaction from the Saudis and the Russians. And here, let me mention a very important point so people can understand what's going on and how to connect the dots. About a couple of weeks ago, probably 10 days, the head of Lukoil, which is the largest oil company in Russia, wrote an op-ed, an article or a column in a major newspaper in Russian. So notice this. He wrote it in Russian in a major newspaper. And the question is, why in Russian in a major newspaper? Who are the audience? This guy is from the inner circle of Putin. And he said, literally, Russia must cut its oil production by 2 to 3 million barrels a day and not sell at a discount. We don't know who is the target, but probably he was sending a message to India or others if it was international. Probably he was sending a message to the army leaders, the Russian army leaders, or even to Putin. We don't know. But the idea here is this article being there from the CEO of the largest oil company. He is asking for a cut in production, a massive cut. Then Lavrov goes to the Gulf and visits Saudi Arabia and Bahrain and others. And there we might find some explanation what he meant, because Lavrov assured the Gulf states that Russia will remain in OPEC plus no matter what. And Russia is extremely important to Saudi Arabia and other countries. Don't believe whatever Biden is going to give the Saudis, don't believe they are going to let this relationship go. Russia has a veto power in the Security Council, in the UN Security Council. Russia is the voice of OPEC plus. Russia is the voice of Saudi Arabia. And look at their votes. They helped Saudi Arabia with Yemen in the vote in the UN Security Council. And they helped Saudi Arabia when they voted on climate change policies. So that is priceless. But when Lavrov came in, he came with several files. And one of the files, basically, we can see the answer to the Luke Oil CEO. And he said something along the line that if we end up with a recession and global demand declines, we are willing to cut production up to 2 or 3 million barrels a day. If you put this story and this story together, the numbers match, but whether they meant that. So in a sense, one of the explanations to what Luke Oil president says is that it is an assurance to the Saudis, ignore Biden, we are standing by you. Back to you.
That's terrific on us. Shrub or three, do you have or Oil God, you haven't spoken up. You're all things energy. So Oil God, do you have a question for or three aces or Shrub for Dr. Alhajji, please? Oil God, unmute yourself, please.
Hello, George. Thank you very much for bringing me up, George. A fantastic space as always. Nice to see you, Dr. Anas, Shrub, and obviously everybody who knows what they're talking about. I think everything the doctor says is going to lead to painfully higher and higher inflation. We have definitely a different geopolitical landscape, as the good doctor is pointing out. I mean, it's not as simple as the United States might in history, because some of these other nations obviously have, looking forward, they have much different allegiances to one another. And I think what Dr. Anas is saying with respect to the UN Security Council is almost invaluable, just given what's happening in countries like, Yemen and the instability of the Middle East. So I think it's going to be very interesting to see what happens with Venezuela, Iran, and of course, we've got the narrative here in North America of the doubling down of climate change, probably going into the midterm elections. So, simply put, when you have an inflationary environment, and whether it's goods or commodities, the answer to inflation is you must create more. You must create more supply. You must create more refrigerators. You must create more oil and gas to bring the prices down. And in this case, it doesn't look like we're going to be in a situation where that can happen. So I guess, George, the question I had, and it was actually going to be for Tommy, but obviously I had a difficult time getting up here, so thank you for bringing me up. The question I had is that obviously the recommendation is cash, and of course, if the equity markets in the United States continue to collapse, which I know, and we all agree that, we're in a dead cat bounce today, a bearish rally or whatever they call it, and then it's going to go straight all this inflation we were all agreeing upon. My question to you is, inflation on the other end of cash is still eroding value. Have we been here in the past? And I'm not trying to get your eyes back to the oil markets, but in general, it could be gold and silver, like your co-host likes. But I'm curious to know, in the past, if you have inflation running so difficult hot, so high, and rates have to go up, that's going to erode the value of cash. And so it reminds me of, and this isn't a similar interest rate period, but it was a similar period of turmoil. When COVID hit, we had the stock market took 30% in a month. And it's largely due to the liquidity squeeze of people borrowing money. And then all of a sudden, the economy's shutting down. Businesses aren't making any money, or people don't have any ability to pay the interest. They're forced to sell stocks. Then the Fed comes out and says a bunch of things that are political, largely, because COVID is arguably just coming to an end now. And then you had the market rally up until, let's just call it January. So my question to you is, if it's cash, don't you run the risk of the government's doing or saying something stupid, just given how high inflation is, and then you're just left time a market that it is insanely irrational. So I just want to ask you that question, but other than that, I completely agree with Dr. Anas saying inflation is going to be higher for longer. Thank you.
So got it. I'm sure. Love your comments. I'm a little bit confused. What exactly is the question, please?
The question is we have cash, in 2020 worth 0.5%. If cash in 2022 to 2023, when this great reckoning is coming, could be worth closer to 2 to 3%, my question to you is, if inflation is running at, let's call it 8 to 10%, what's the incentive of holding cash for longer? Wouldn't these asset managers charging fees do anything they can to invest the money to outperform inflation?
Well, so let me answer it this way. We've tried to remove participant bias. Let's cast our minds back to, say, Amsterdam in the 17th century at the time of tulip bulbs, or Beanie Babies about 20 years ago. You pumped up the price of these worthless assets through excess money creation. There's little, if anything, that can be done to support that. Once the momentum breaks, I mean, people are buying this crap not because of any inherent value, just because number go up, bro. Well, once momentum dissipates and goes the other way, they'll sell it for one reason and one reason only, and it's because number go down, bro. So there's not a whole lot that can be done to support the price of tulip bulbs or Kathy Woodstocks or Beanie Babies. And so if the choice is Beanie Babies or cash, I think anyone in their right mind would say, well, I'll take cash, please, instead of Beanie Babies. So then you say, okay, well, the price of cash is falling by 8 or 10% or 15% in real terms, which is where your question goes. And so we're not buying something which is at least hedged or levered to the thing which is causing cash to be devalued, i.e. inflation. The answer is yes. So I like the way you asked the question, because you're not trying to rail me into getting you to support the oil position, but ultimately that's where it goes. You want to own the thing. The way you hedge against the inflation is by buying the inflation. You buy the scarce asset. Kathy Woodstocks and Beanie Babies and tulips are not scarce assets. Oil barrels of oil coming out of the ground are scarce assets. Yes, you still inevitably led back to energy. The real question is, and the reason I became more cautious in recent in recent weeks, is because I was worried about a more generalized decline. So you can do it either one or two ways. You either say, well, we have a big generalized decline, it's all going to go down, and we'll just be on the sidelines, is kind of what I've done. Or whenever I own energy, I've got the Kathy Wood position on as the hedge. So either way, I just am afraid to be naked long anything, because I'm fearful of a generalized decline. You go from rising interest rates, bond prices going down, to credit conditions intensifying, problems intensifying, to maybe where you have a liquidity drain. And in that scenario, anything that's not tied down can be sold. So that's the cautionary note. But ultimately, I struggle. I find it impossible to. I find it very difficult to see a scenario where energy does not outperform the market generally. And so, if you said to me, what's the highest Sharpe ratio trade? It's probably not short energy. It's not long energy. It's long energy against something else. And whether you want the something else to be consumer stocks or Kathy Wood stocks or the market more generally, I think that's a higher Sharpe ratio trade, because you're hedging out the potential of a generalized market decline. I also think it's a higher absolute return trade. It dominates all other trades. So, my fellow Canadian oil mafia brethren, I just want to let you know how you've been missing out. You actually missed it. The only thing better than owning Canadian energy stocks this year, or energy stocks generally, has been to be long energy and short Kathy Wood. So I'm just going to pick Eric Nuttall, who we can just use him as a benchmark, so we don't get caught up in the idiosyncratic risks of any particular name. Mr. Nuttall's fund is up about 80% this year. However, if you were long Nuttall and short Cathie Wood, you would have made 80% on the long and you would have made about 60% on the short. So you'd be up 140%. And my view is not only is that a higher return trade, but it's also a lower risk trade. I hope that answers the question.
George, I just want to make two quick comments, and then I'm going to cede the floor. I want to thank you for your humility. One of the reasons I love you and your spaces is because you tell it how it is and you don't bullshit. And it takes a man to really say what you do know and what you don't know and work with the experts. And, you know, you don't know what it means to the younger generation to hear that from somebody from your generation, because we're not used to hearing that. And so I want to applaud you on that. The second thing I want to say is point to an earlier speaker, and this is going off of the good doctor, who I consider an uncle, which in Middle Eastern culture is about as complimentary as you can get for a family member. The good doctor had mentioned the thing that's likely going to come about the political, scrambling the Biden administration is doing today. What does he have to do? Well, he has to go to Saudi Arabia in an attempt to alienate, obviously, what Russia and China are going to attempt to do with respect to, influence of the United States. Let's just use the doctor's thesis and say it's not going to go well for Biden. A previous speaker had talked about the short interest in energy and energy equities. All I'm going to tell you is watch, because you've got two convoluting things happening two things diverging at the same time. You've got Q2 earnings, where you, George, were the person first to bring this to most people's attention. The dollar strength and what that does to Canadian energy earnings. Well, the dollar's strong, and they're about to go into Q2 earnings with WTI prices averaging somewhere between $120 to $130 equivalent for the Canadian producers. The second thing you're going to have is geopolitical risk to the upside when these squeezes get short. I'm going to leave it at that. I want to thank you again, George, and Nas Shrub. And, again, thank you. You've done a great job and a great service to the rest of us.
Thank you, Olga. I appreciate that. Thanks for your kind words. Hey, Three Aces, are you there, Three Aces?
I am. I'm listening.
Yeah, okay. I have to step away for 10 minutes. If you could please run the room. I have to step away for 10 minutes. I'll be back.
No problem, man.
Thank you.
Hey, Doctor.
Hey, Three Aces. Can I ask a question to Anas, or do you want to go first?
Brother. No,
go
thanks.
for it. Dr. Anas, look, there's something that I've been really struggling to understand. And I think most people don't really think about it. So we have WTI at 120, but obviously diesel is 300. So the crack spreads are adding more than $80 per barrel. Yet obviously politicians are attacking the oil firms, but no one's saying, oh, how do we deal with refining capacity? So anyway, the simple question is, if WTI is 120 and diesel is 300 or whatever it is, the obvious thing is for to actually be bullish the consumer is, how do we see the refining margins coming in to more reasonable levels? Because that would be the real boost to the consumer versus oil going down $20 if you can get the refining margins down 60 or something. So I'm really struggling to understand that, if you don't mind.
Generally speaking, we have a serious problem worldwide, and it's twofold problem. The first problem, during COVID, the demand for petroleum products declined substantially. And what you get when you are in a refinery, even if there is no demand for a certain product, you are going to produce it no matter what, because that's the way the refinery is configured. They have kind of a leeway in terms of percentages here and there, etc. But there are certain products that are not in demand will be produced no matter what. So how the market reacted with the surplus, they started mixing. So the jet fuel demand got hit because the number of flights globally declined substantially, but you have a lot of jet fuel. So what you do, you try to minimize the production of jet fuel on one hand, and you try to increase the demand for jet fuel by mixing it with other products that are in demand, and that in a way that does not change the function of the product. So this mixing lasted for over a year, and to unwind that takes time. So this is the background. And then we have serious problems because of the impact of COVID, because of people left the industry and never came back. We have some technical problems. We have the hurricanes in the Gulf of Mexico, and we have the environmental regulations that some of them existed before. We have some refineries that completely shut down because some private equity just ruined it. And they couldn't sell it. They couldn't do anything because of the environmental regulations. So all the issues combined add to it that India and China limited the exports of products in recent months as supposedly as a reaction to the Russian invasion, and they don't want to experience shortages. So we have shortages all over. Some of it is organic shortage, and some of it as the result of politics. So the situation will ease, especially now India and China are exporting the products that are coming from Russian oil. So that will ease and the margins will decline. But that's not going to solve the US problem at all, because as margins decline, especially if they decline substantially, there is no incentive for US refiners to produce more. And the US, whoever we are going to have in the office in 2025, they have really to look really hard at the refining sector. And we have to have a very clear view on how to deal with it. Otherwise, the US is going to start importing gasoline and diesel from around the world. And yet, we have the shale revolution. We produce 11.6 million barrels a day of oil, but we are short gasoline, we are short diesel, and we are going to import that from various countries. And God forbid, we might go back and import it from Russia again.
Thank you so much. That's very helpful. So basically, it's a structural issue. We shouldn't be expecting an easing back to the pre-COVID levels at this point. And we're talking about a few months, obviously, like months to normalize to something like a higher base, right?
In a sense, the structural issue is part of the story, not the whole story.
Right. Thank you so much.
Okay.
Hey, Doc. How are you, my man? Excellent. Question for you. So, do you mind walking us through how many barrels a day we were producing at peak, how many we're producing now, and then if we are, I know George doesn't want to talk about the recession word, but if or when we go into a recession, what that might look like in terms of a surplus of oil and what impact that might be on the market, if there would be one. Thank you.
Generally speaking, we hit, I think, 13.6 million barrels a day at the peak, and then declined to below 10. Now we are at 11.6. So we are 2 million barrels below the peak in crude production, and we are about 2 million barrels a day in refining below peak. If we end up with a recession, so we can combine both ideas here. If we end up with a recession, I think what Oil God was alluding to is the following. Many of those oil companies, especially the shale companies, they suffered even after 2020 simply because of hedging. They hedged at low prices, so they were making $40 to $50 while oil prices were above 75. But those hedges already ended, and now they are hedging at the higher price no matter what. So even if we have a recession, most of those oil companies, whether the Canadian or the US companies, especially shale companies, those that are hedged, they will be fine. Especially if the duration of the recession is no longer than 9 months. But there are companies literally that bought their hedges and they just got out, so they are naked. They will get the lower price. The question is, what is the lower price? Will we see prices below 60 in case of a recession? It is very difficult to see prices below 60 for several reasons. Simply, we don't have enough investment. We don't have enough oil. We don't have enough production. But it is expected that OPEC Plus with the Russians will start cutting production again to prevent prices from declining below $60. One issue here I would like to bring up is the value of the dollar. The problem here is this. If the dollar keeps going up, even if oil prices decline, prices in countries where their currencies is declining or depreciating will not decline, or may not decline, or will not decline as much. And therefore, this is a threat because as oil prices decline in dollar, they are not going to decline in non-dollar. And that is a big problem for them. If the dollar declines, it's exactly the opposite. If we have lower oil prices and lower dollar, then that encourages demand for oil. So any way you look at it, it's very hard to see oil prices declining in a way that hurts the U.S. Oil industry. What we might see is the following: that the investment that is being planned for now and next year based on current strip, that investment might be delayed, and that's going to make the bullish case in the long run even stronger. Back to you.
Right. So would you expect to see a surplus in a recession to where the supply and demand situation eases a little bit, or will you still see a shortage?
No, that's a great point. Even today, we don't have a shortage. The idea of a shortage, basically, we haven't even, if you look at the U.S. Commercial oil inventories, we have not even touched the critical point, which is the 395 million barrels. We are way above 400 right now, and we never touched the 395. So we are still good in terms of commercial inventories, and we released 180 million barrels from the SPR, and they will continue releasing that for a long time. So what's going to happen is, in case of a recession, you made, I think you stated this beautifully when you said it eases. And yes, it is going to ease the situation in the market where inventories are going to rebuild. But what's going to happen is a country like China is going to buy like crazy to replenish their strategic petroleum reserves that's been withdrawing since May 2021. So there will be a lot of buying for strategic petroleum reserves. Since we are talking about strategic petroleum reserves, the U.S. might, if with a decline in prices, might halt the sale of the SPR. We've seen it with Trump. Trump was mandated by the Congress since 2015 to sell oil, but with a presidential order, he halted the sale because prices were low. And we might see a reversal in the Biden policy when prices decline, because there is no need to sell that oil. However, I think there is a fundamental change in U.S. policy toward the SPR, or the Strategic Petroleum Reserves. I think everyone realized that the Strategic Petroleum Reserves was built when the U.S. was heavily dependent on imports from the other side of the world, and the U.S. was dependent on certain crude quality imports from the rest part of the world. After the shale revolution, this amount of crude is not needed, and there are certain qualities not needed, and therefore you need to get rid of the SPR. I think the Biden administration took advantage of the Russian-Ukraine situation to change the SPR completely. So when they buy again, assuming they sell everything, when they buy again, probably they will buy only half of the quantity. The SPR will be lower than before. They sold it at a higher price, so they made money. That's good for them and good for the taxpayer. But at the same time, whatever they are going to buy, they are going to buy of a certain crude quality to adjust for the shale revolution. The shale revolution brought in light crude and condensates. Therefore, we don't need to store light crude and condensate. We don't store condensate anyway, but we don't need to store light crude. We need to store the heavier crude and the medium crude, and therefore there was a strategic objective from selling the SPR. Therefore, the U.S. may not buy, it might hold sales, but China in particular is going to buy a lot. Back to you.
Yeah, doctor, before we go into a couple of hands, I'm just curious about, where I am and where I live in my business. I'm in the emerging markets, currently and so on. I keep seeing all these crazy things about diesel in the Northeast and all that stuff. I'm buying diesel for $4.50 a gallon. I'm just curious, how much of this sort of, price pressure that we're seeing and drama, where we've saw a bunch of it in commodities which have passed, but it's still there in oil, has to do with the centralized pricing mechanism of WTI and Brent. And do you feel like there, if the crudes were priced more regionally, the carbon, that it may have an impact on the overall quote unquote market for stuff, or is that am I on the wrong track there?
No, because we have what we call geographic differentials and we have quality differentials. So the system you are looking for is already happening anyway. So even regionally, you are going to see either discounts or premiums based on several factors. Back to you.
Got it. Thank you. Hey, K chart. We're going to go to Josh. He came up first, then we'll go to you. Go ahead, Josh. Question for the doctor or anybody else in the room?
Sorry, I was on mute. Sorry. Yeah, 3 years is really appreciate, man. I love your space, man. I really love you both. I really love it, man. I love the space. I had a question for the doc. You just mentioned also about the oil. Every time oil goes higher, which is happening in 1990 happened, then in 2000 happened, and then it happened in 2008. Every time recessions hits, you said before, there is always oil price always goes up, right? So what do you think at this time? You think the recession, we are already into recession, or you think oil first gonna peak out and then we're gonna in the recession, and then if we will be in the recession, you think the oil price will remain up, or is the oil price gonna go down with the recession?
Since this is a macro question, I would leave that to George and Three Aces and other people who talk about macro. Thanks.
Okay, no problem. So probably I would add another thing in this point. 3 years is actually what I think is this probably because of we have to look at this is the scenario where we have never happened in history.
Yeah, Josh, we have 1,200 people in the room,
Okay.
and the doctor doesn't like to talk about market prices. He's a strategist and a researcher on the quantitative side for industry. Do me a favor, sit there for a few minutes. We got a couple of questions.
Sure, no
K
problem.
chart, and then we're going to go to somebody, Amir Al Sulaim, please. Go ahead, K chart. Question for the doctor.
Yeah, I got a question for both of you. I guess George had stepped away. All right, so somebody mentioned the gold and silver, right? Possible as places to look other than cash, right? If we can get to that later, as we're done with the energy or the commodity side of the conversation, what do you see, right? Would be catalysts for those areas to, I guess, start gaining a little bit more momentum in the precious metals. The doctor, I'm sure you had seen this, not this weekend, but the previous weekend. Chevron CEO had come on to Bloomberg. They have a show over the weekend. So the CEO, as well as chairman, and had stated that the refining capacity that you had mentioned briefly, I know we've been talking production of barrels of oil, but the refining capacity, there hasn't been a new refinery built in the United States since the 1970s. The largest refinery in the U.S., Motiva Enterprises, by volume, if I'm correct, was bought by OPEC, or I shouldn't say OPEC, the Saudi government back in 2017 after Harvey. The remaining stake, I believe, at that time was owned by Royal Dutch Shell. Do you see that as well, because of that refining capacity that you did speak was roughly also 2 million barrels, or around that amount, below the high capacity? Do you see that continuing to also be a problem when it comes to the stabilization of the prices or not?
First of all, we do need to distinguish between messaging that is intended for politics or strategy versus messaging related to the market. That applies to OPEC, for example, just for clarity. If you listen to OPEC ministers when they are in OPEC meetings or the conferences, the press conferences, what they said is completely different from what they said in general conferences. So you look at what the UAE minister said last week, or the others, they were talking about we don't have enough capacity, etc. But they never said that in OPEC meetings, remember. So, excuse me, just a second. So we have an issue here where everyone knows in the Gulf that Biden is going to visit the Gulf. So there is a lot of messaging going on. We should not base our investment on political messaging, but we should be considerate and look into it. The same thing for Chevron CEO when he said we have not built a refinery in a very long time. So look at those numbers, which is kind of really counter what he said, and that proves the point was more strategic and political. Crude into refineries increased from 11 million barrels a day in the mid 80s to 18 million barrels a day before COVID. So yes, we did not build any refineries during that period, but the ability to process crude increased by 7 million barrels a day. How did you do that? Look at the other number. U.S. consumption of products, that's petroleum products, increased from 16 million to 22 million. So we have 6 million barrels a day increase in consumption. Where did that come from? U.S., and you might say, well, we imported more because we don't have enough capacity. Look at this number. U.S. petroleum products, that petroleum product exports increased from 2 million barrels a day in 2010 to 6 million in 2022. I know that most of this are gas liquids, but still our exports of gasoline increased substantially and other products too. So how did we do that? We did that because of the brownfield expansion of refineries. So we did not build new refineries, but we expanded the current refineries. And that brings us to what I mentioned earlier. Motiva, which is owned by Saudi Aramco, is the largest refinery in the United States. It was intended for expansion, and then they couldn't. And they could have expanded. Guess what? Saudi Arabia right now is awash with money. They have a lot of money. They have the PIF, which is the sovereign fund of the government that is intended to be the largest in the world. They are looking for investment worldwide. And this is part of the negotiations probably with Biden, which is the Saudi investment in the United States. Will they expand the refinery? Will they buy other refineries and expand them? That's why there is a solution that is in the hand of Saudis, because they have the money and they own the company. So what Chevron CEO says basically to me is more of a messaging than actual reality. Refiners today can expand their own refineries. They can modify, they can be more efficient, they can increase efficiency, etc., to increase production. However, the environmental regulations of refineries is a serious problem. Then we have another issue that climate change, or let me say it, those who are on the extreme left of climate change, they are using every opportunity to literally derail the oil industrial, the refining capacity. What they are saying right now is there is kind of an environmental justice and discrimination against African Americans. Why? Because they found out that African Americans live around the refineries and they get all the pollution and all the negative health impact and this stuff. And they forgot an old law from the Roman times. When it comes to those issues and who is hurting whom, it depends on who is there first. Had the oil industry moved the refineries to black neighborhoods, or they built the refineries outside the cities, far away from everyone, and then everyone moved around the refineries? But yet, climate change extremists are using that, so they are moving beyond the issue of environment and climate change to social justice and discrimination against African Americans. Back to you.
Thank you.
Thanks,
Thank you for
Doctor.
your. Thank you. I forgot to thank you.
Garbanzaria. Hey, my brother, come on up.
Hey, how are you?
Good. How are you?
So I have a question for the doctor.
we're building all these EVs. New cars we produce get greater gas mileage. In theory, should demand be dropping, not rising?
Jeff, I think we should have a special space on this because that takes a long time to talk about. But briefly, look at this. If you look at the IEA forecast to 2045, you will see they are forecasting a major drop in oil demand because not because of electric vehicles, but because of improvement in efficiency of ICE vehicles. Looks ironic. So the largest drop in the forecast is in the improvement of efficiency of gasoline and diesel cars, not in the number of EVs. The problem is, if you really look at the numbers, the efficiency they are looking at makes electric vehicles obsolete. And you cannot have it both ways. If I'm going to have this efficiency and it's way better than electric vehicles, why do I need electric vehicles? So you can see that those numbers and the forecasts are made up. But we'll be happy to discuss this in more details. I think we've done it once about 5 months ago, and it is a very interesting topic.
Oh yeah, I'm definitely going to go back and listen to that. I'll bug George about it. Thanks for the answer.
See you, Jeffy. Hey, Amir, how are you, my brother?
Yeah. Thank you so much for giving me the chance. I'm just going to say a few remarks, and I would like the gentleman, I appreciate his thinking so very much, Dr. Anas, to comment after I say maybe 3-4 points, no more than 40 seconds. Every time I hear trade talk, I cannot, stop thinking like going in a cruise, beautiful casino, and everybody enjoying their trades. They forget that they are not playing against each other. They play against the dealer. Now, some of you earlier said, I'm not sure whether I should believe the newsmakers or the traders. Now, you can believe the traders or the newsmakers as you want. However, you have to understand that the traders are playing to win short term. The newsmakers' problem is that they always have hidden agendas. You don't know who to believe. My comment, we are not in a business as usual situation. And my advice to the traders, you can trade or you can sell or you can buy. My advice is to go with the or. Now we are going through a turbulence, really serious turbulence situation. When the oil price went up to $140, shortly after that, it went all the way down to $37. And I don't know if you remember, Dr. Anas, about 2 months ago, when the price of oil was about $70, I said, wait until July. It's going to hit 200. And I can see it clearly moving now. What is it? 121? It's moving to that target. Sorry, too many comments I made, Dr. Anas and everybody, but I always enjoy your discussion. Remember, you're not in a casino, you're on a ship in a turbulence mode. Thank you so much.
Thank you, Amir. I can see you're a corporate corporate officer of the largest oil and gas company in the world. We appreciate you coming in. Just curious, what part of the price structure here would you attribute to short-term speculation, given Ukraine and ESG and the wacko political in Washington D.C. these days? Do you think there's a premium there?
I think we're going through a very strange situation. We have 4 crazy leaders Allow me to say the word crazy. And I'm not going to say and name any one of them. 4 crazy leaders. And they are pushing all kinds of buttons. God knows for whose benefit. You know what's the inflation now in the US? It's more than 9.6%. You know that people are starting to eat spaghetti and tomato in Italy. And why? Why are we doing this? Why? There's something not right. And I think it will transpire. It will resolve itself. Like every time, the world go into chaos, it resolves itself. It will resolve itself in 2 months. Somebody has to give in. What's happening in Ukraine is a shame to humanity. A shame to humanity. Nobody should be sitting in their house or flat expecting a bomb. Nobody. Nobody. I don't know. In 2 months, things will transpire.
I could not agree with you more. We had some folks come up who may want to ask some questions. Where were they? Was it Bick? Bick, do you want to go next?
Yeah. Hi. This is a question to Doctor. So I am trying to understand the bigger picture of this Ukrainian war. And I am thinking of a scenario, a big chess play by the Russians to capture the market, long-term market share from the Middle Eastern country. So what the game of Russia could be that because of the efficiency, this efficiency of the ICE engine will come from the hybrid vehicles, because hybrid vehicles will get 100%, 200% more mileage from the small battery, which we can afford. So as in the longer term, although in the shorter term I'm oil bullish, but in the medium longer term, due to this efficiency of hybrid engines and pure EV, the oil demand will surely go down. And in that case, Russia want to capture the main growth market, which is India and China, and give where the demand will fall, which is the European Union market, to the Middle Eastern country. So it may be that it is a bigger picture, energy transition, big game plan of Russians to capture the biggest ghost market from the Middle Eastern countries. What is your view, Doctor?
Beck, on both fronts, I'm sorry to say you are wrong. The first one is Russia and the rest of OPEC Plus, they complement each other, and there is no competition, especially when the demand is rising. On the second front, on the EV and the efficiency, etc., let the numbers speak. For oil demand to stay where it is today at 100 million, we need 700 million electric vehicles on the road by 2050. 700 million. And when I say electric vehicles, I'm not talking about scooters. I'm talking about the four-wheeled actual cars. We need 700 million just to keep demand where it is right now. So the idea that demand will decline, you need more than 700 million. How many vehicles we have on the road today in the world? Less than 30 million. So imagine the difference. And imagine how much cobalt, lithium, and nickel, or whatever new metals and minerals you need. Imagine how much you need for that. Regardless of all of this, remember the following. Myself, I am very bullish on oil in the long run. And I say bullish, probably more bullish than anyone else in the world. Why? Let me explain to you a technical issue. If we need 100 million, let's go with your view that demand will decline. Let's go with 75 million. So demand will decline from 100 million to 70 million. Let's go with your view. That 75 million in 2050, all of it has to be fresh oil that we don't have today, which means that we need trillions of dollars of investment to get that fresh oil. And a decline in demand in the future does not necessarily mean a decline in prices, because we could end up with 75 million barrels a day with the prices of $300 and with the dollar basically being at even a higher peak. than where it is today. So the idea that lower demand is not going to happen, but even if we go with it, that still make us bullish because we don't have any of the oil. Why? Because as you extract oil, we have something called decline. So that's the decline rate. We need replacement, and to replace it, we need investment, and that investment is not there yet. So any way you look at it, whether the demand will decline or not, we are bullish on oil. But I can assure you that demand is not going to decline. Look at what happened in Louisiana just 2 days ago. The state of Louisiana basically mandated additional fees on electric vehicles. Now we have 14 states in the United States basically imposing additional fees on electric vehicles. Why? Because they don't pay gasoline tax. Look at Norway. Now Norway is reneging on its policy. And Norway is the most active, despite all the environmental things and the EV, etc. Norway is the most active country in oil exploration today. So the trend is not there. We are seeing a place like Sweden is going back to oil fire generation. So the idea that oil demand is going to decline because of these things is not going to happen. If you look at every kid in Africa, he literally wants what every American and every European wants. And Three Aces basically saw this firsthand, and he can tell you more and more about this. Back to you, Three Aces.
Yes, I did, Doctor. I did see it firsthand. I lived it for a decade. Yeah, big world out there. Hey, SR, Scirocco, Daniel will come to you. Do you have a question?
Yes, sir, I do.
Oh, hang on, Daniel. SR Scirocco report. Come on up, brother.
Yes, thank you. Can you hear me?
Can hear you perfectly.
Okay, this is Dr. Annis. I just want to make this quick. I appreciate his insight on the SPR and the capacity factor. I wanted to ask his opinion. I don't think the market has taken this into consideration that past legislature in the U.S. has 300 million barrels already to be sold off the SPR from 2022 to 2032, in addition to the Biden 180 million. So in the next 5 years, they're going to sell 200 million barrels. What does he think this is? What kind of impact on the market? And is this a good idea to do?
Yes. First of all, let's kind of set the record straight that there is an overlap between those laws. So the same quantity is accounted for twice or thrice. Regardless, long ago, years ago, there was an agreement, especially among Republicans, that we should eliminate the SPR completely. Some Democrats basically agree with them because they think the SPR is a subsidy to the oil industry. And by the way, it is a subsidy because the oil industry should hold more commercial reserves if there is no SPR. So that's number one. Number two, many people believe that after the share revolution, there is no need to hold 700 million or the 650 million that existed before the withdrawal. And therefore, we should lower it simply because we are producing about 8 million barrels a day from shale that did not exist before 2010. So there are reasons, real reasons, to reduce the size of the SPR no matter what. At the same time, the SPR was, when it was established in the 70s, it was meant to cover imports in case of an embargo or natural causes or technical causes, whatever. And because shale, as you know, is light sweet crude, and we first, before we allowed exports of U.S. crude in 2015, we substituted imports. So we stopped importing light sweet crude because we already have it within the borders. And therefore, there is no reason to store light sweet in caverns in the strategic reserves. What you need is the quality that is in danger. And what is the quality in danger? It's the medium and the heavy. And therefore, we need to change the quality. So you have emphasis on quantity and you have emphasis on quality. And what Biden did was a great opportunity to do that shift in terms of quantity and quality. At the same time, make money because it's being sold at prices that are very high. And at the same time, trying to, and please everyone pay attention to this. Yet the Biden administration announced the release of 180 million and prices did not decline below 100. But if you do some analysis, you find out that it prevented oil prices from reaching 140. So there was an impact on the market, but an impact that we did not see. I hope this idea is clear. Thanks.
Yeah, understood. Hey, doctor, what's the story down in Venezuela and the politics and the potential supply there? Is there a story there or no?
Yes, I'm glad you asked this question. That shows two points. The first point is it shows the Biden administration desperation on one side because they are talking to the Iranians about it and they've been shut down 2 days ago by the Iranians, so they have no luck with that. And their idea is they allowed two European companies, that the Italian Eni and the Spanish Repsol, to export Venezuelan crude to Europe. So that was very specific to Europe. And they wanted to talk to the Iranians basically to export crude to Europe without reaching a nuclear agreement. The idea here, at least from my point of view, is that the Biden administration wants to strangle Putin the same way they strangled Saddam Hussein, in a way that if I need to dry up the resources of his power, which is money, and money is coming from oil and gas, and therefore I need to make it less and less and weaken him. And therefore, I am ready to kind of sacrifice my issues with Iran and my issues with Venezuela, especially when it comes to human rights and everything else. I'm ready to sacrifice all of that in order to weaken Putin. And therefore, the objective is clearly strategic. And let's remember that when the Biden administration asked Saudis and OPEC members in August 2021 to increase production, now we understand it was exactly for the same objective, because they knew that Putin was moving in and they knew they have to impose sanctions, so they wanted to strangle him, but they underestimated the power of the coalition of OPEC Plus in this case. Whatever is going to come out of Venezuela is going to be exported to Europe, is going to be at the expense of Asia and other countries. Therefore, it's not going to be an additional oil. However, can Venezuela increase production? Yes. They can increase production within a very short period of time, like I'm talking about weeks, 400 to 500,000 barrels a day. If they can get the diluent, if they can get the natural gasoline, which we use C5 for it, if they can get C5, whether from the US or other places, of course, they cannot do it right now because of the sanctions. The Russians were supplying them, and now the Iranians are supplying them with that. But they need extra to be able to increase production. If they can do that, then they can send extra oil to Europe. If they cannot get it, then they cannot do anything. It will be just switching trade from area to area, and that's going to increase prices. One of the ironies is, and I wrote this on Twitter, that Iran is exporting those diluents right now to Venezuela. And with any deal with Iran, this could be written, literally written, that Iran must help Venezuela, or unwritten. Either way, there will be some sort of an agreement that Iran must help Venezuela, and probably at a lower price, because they cannot ask the Russians to do so, unless until they legally lift the sanctions or give exemptions to some U.S. producers by name. They have to name the company to allow exports of natural gasoline to Venezuela, so Venezuela can increase production by the amount I mentioned, so they can reach probably 1.2 million barrels a day. But above that, they cannot. They need long time to increase production above that amount. Back to you.
Got it.
Can I ask a question real quick?
Sure. Go ahead.
I just want to, Doctor, could you tell us what you think Biden going to Saudi, what do you think comes of that, and what do you think that this meeting is about? besides oil, obviously.
The political implications are huge. But we don't know anything about the economic implications and what is the impact on the oil market and the gasoline market. My hunch, basically, my view is that the impact on the oil market and the gasoline market in the short run is almost non-existent. The Saudis basically might redirect trade, they might redirect shipments, etc. But the impact on the overall market is very limited. In terms of politics, I think there are some really serious, big, serious issues because you have the Yemeni file, you have the Iranian file, you have the Syria file, you have the Iraqi file, and you have the Israeli file. And then you have the islands, Saudi Arabia historically, to avoid being on the border of Israel, they give two islands to Egypt like more than 50 years ago, which called Tiran and Sanafir. And now the Saudis ask Egypt to return it, and Egypt returned those to Saudi Arabia. The problem is there is an agreement, part of the 1979 peace agreement peace accord between the Israelis and the Egyptians related to demilitarization of the islands. And the Israelis are wondering whether the Saudis will obey by agreement or not, etc. So this is still in dispute, and people think that this is going to be resolved in this trip when Biden goes there, and he will get assurances for Israel regarding those two islands, so the transfer can be complete. Back to you.
We're going to take one more oil and gas question, and I think George is going to be joining us here maybe after this question. His Excellency from Saudi Arabia, please go ahead, sir.
Thank you. Thank you for the excellency. I just wanted to express my utmost appreciation to this. It's always high, and what makes it really beautiful. And we should really, give a hands up to Dr. Anas. He's sparing his energy, his knowledge, and his time for free. And what I know of him through the spaces, I don't know him personally, and I would be honored to know him. What I know of him is that he really volunteers. He's an eager person to spread good, solid knowledge. And for that, excuse me, I would have to leave. I loved it when you said His Excellency. I don't know how sarcastic is that, but anyway, it's good. Thank you so very much. And I always love to joke and, you know, mix some pleasure with some serious business. Thank you, Dr. Anas. Thank you, Joe. Or, sorry, I didn't see the name. I don't have my glasses on. The host. Thank you, everybody. And may Allah let us pass these only 2 months, and things will be back to normal, hopefully. Wish you
Inshallah.
all the best of luck, inshallah.
Inshallah. Thank you, sir. We really appreciate you coming in here. We know it's late over there. Have a good night tonight.
Thank you, sir, and thank you, Dr. Anas, again.
Great. George, I think maybe coming back in a minute. We may have one time. I know Daniel's been sitting there for a little bit, and he's a grad student, doctor. So
three aces.
Oh, there you're back. Okay.
Yeah. Hey. So let's take 5 more minutes, and that's going to be it because this room is going on 4 hours. It's gone on way longer than I thought it was going to. So we could talk forever, and we're going to do it. We're doing plenty of more rooms. Don't worry. I know we hadn't done a room for a week or so. I was away, but we're doing a room on Tuesday at, I believe it's 11 a.m. with Julian Brigden, who's been so right on interest rates and inflation in the economy. So that's a don't miss session. That's 11 a.m. Eastern time on Tuesday. I had a meeting reminder up. I had to take it down because for those of you who aren't aware, there's this feature on Twitter. We only can advertise one meeting at a time in advance. It's really very annoying. So in order to post this room, I had to take down the other one. So 11 a.m. 11 a.m. Tuesday Eastern time. Mark your calendars. All right, 3 aces. I think we're at 4 hours. This is really a lot longer than I anticipated. So if you're good with it, I think we close the room. Any thoughts?
Yeah, I think we've covered an enormous amount of real estate here and another great spaces, George. Thank you very much for having.
Awesome. And everyone, 11 a.m. on Thursday, Tuesday, I'll post it. Julian Brigden, he's been really smart fellow out of London. He's been writer's reign on the economy and inflation and interest rates. If you like James Ferguson a few weeks ago, it's similar type of point of view. Really, really smart. Again, I want to thank everyone. Dr. Alhajji, thank you so much. Amy, Three Aces, Tommy Thornton, Jeff Carbaster, and Lizzo. The others who aren't even here now. This has been an awesome room. See you guys on Tuesday. Take care. Be well. Bye-bye.
Fantastic space, George. Thank you.
Bye. Bye.